Hello there. How are you? I want to welcome you to this course on how to trade the US 100 full course. Now, in this course, I'm going to offer you a simple guide on how you can trade the US 100. US 100 also means the Nasdaq. It is a basket of 100 US companies which are traded on the on the Nasdaq Stock Exchange. So in this course, I'm going to share with you everything that you need to know to become a profitable US 100 trader. And I'm going to present it to you in a step-by-step process, something that you can easily understand. There's nothing complicated about it. Trading is one thing that should be very easy for everyone with an average understanding to get. So I'm going to do my level best to ensure that everything that I'm going to present to you in this course is something that you'll be able to resonate with, something that you'll be able to relate to, something that you'll be able to easily grasp and build a strategy out of. Everything that I'm going to explain, from what is NASDAQ to also taking entries and exit, and also how to manage your risk in NASDAQ, is something that is going to be explained in a simple format, because my goal is to help you achieve consistency in your trading. And NASDAQ has been one of those indices that a lot of traders have been trading, and of course they are making quite a good fortune out of it. So in this course, I'm going to do my level best. I'm going to ensure that we work together from point A to point Z and ensure that everything that is going to be taught to you is taught in a simplified manner. I'm not here to complicate things. I'm just here to make things easy for you to understand. And also, I want to appreciate you for taking your time to patronize this course, for taking your time to purchase this course. I don't take it for granted that you are going through this course. Actually, it is an honor for me to have you in this course. So come with me as we delve deeper into how to trade the US 100 course. I'll see you in the next video. Hello there. Welcome. Trading Nasdaq 100 has never been easier than this. And in this course, I'm going to present the best knowledge that is going to make you a consistently profitable Nasdaq trader. I don't intend to keep you long in this course. My objectives are very simple. That is to present the material to you in a more simplified manner and in a way that you can understand. Now, come with me as we get into the introduction of what NASDAQ is. So what is NASDAQ? So the NASDAQ 100, or the US 100, is a stock market index that is made up of 102 equity securities issued by 101 of the largest non-financial companies listed on the Nasdaq Stock Exchange. Now, why 102? Because some companies have been divided into two parts. For example, Google is a very big company, and because of that, it has got alphabet A, and also it has got two companies, let me just say. Okay, so that's the reason why you find that the number goes up to 102. But however, the basket contains 100 companies. So it is a stock market index. Okay, so it's a basket of 100 companies, meaning that if you're trading the Nasdaq 100, you are trading 100 companies at the same time. It is a modified capitalization weighted index. And what does that mean? It means that stocks weight in the index are based on their market capitalization, with certain rules capping the influence of the largest component. Now, what this means is that companies in the Nasdaq 100 or the US 100 stock index are listed according to the market capitalization. So meaning that the company with the largest market capitalization has the huge impact on the index. It affects how the index work. And that's how the companies are listed in the Nasdaq 100. Now, it is limited for companies from a single exchange, all right? And it does not have any financial companies. So what this means is that only technology companies are listed in the Nasdaq 100 index. Okay, so whenever you're trading the US 100 index, just know that you're trading the 100 technology companies in the USA. That includes Apple, Microsoft, Tesla, Google, Amazon, Nvidia, Intel, Netflix, Meta, which is formerly known as Facebook, MasterCard, etc., etc. All right. So all the 100 technology companies are listed in this 100, in this US 100 stock index. So if you are a tech enthusiast, it is going to interest you to look at the Nasdaq and also trade the Nasdaq, because if you're trading the Nasdaq, you know that you are also participating in Apple, you're also participating in Amazon, and you're trading all these companies at the same time, just in one index or in one basket, which is the Nasdaq 100. Now, there are financial companies. The financial companies are in a separate index, which is the Nasdaq Financial 100, meaning that the Nasdaq Stock Exchange also has the financial index, which tracks how financial companies are performing. But the Nasdaq 100 index, all right, is different from the Nasdaq Financial 100. The Nasdaq 100 index tracks the performance of the 100 technology companies. All right, so let's look at the brief history. So what's a brief history? So the Nasdaq 100 was launched on January 31st, that is 1985. That's when the Nasdaq 100 index was launched by the Nasdaq. So it is quite a, an odd index. It has been there for quite some time. It was created, the Nasdaq created two indices, and that is the Nasdaq 100, which comprises of technology companies, and also the Nasdaq Financial 100. So the entire stock market, which is the Nasdaq Stock Exchange, created two indices. One is for technology companies, and the other one is for financials. And then foreign companies were first admitted in the Nasdaq 100 in January 1999, but had higher standard to meet before they could be added, meaning that other companies from other countries, okay, were started being included in the Nasdaq 100 index by January 1998, and that was when they meet the standards which they set for them. So a company cannot just find itself in the Nasdaq 100 stock index without meeting the minimum requirements which they have set. And these minimum requirements are high standard, which is required of those companies to be added into the Nasdaq 100 stock exchange. So the standard were relaxed in 2002, while standards for domestic firms were raised, ensuring that all companies meet the same standards. Okay, so what that means is that for a company to be added, a technology company to be added in the Nasdaq 100 stock index, it has to meet certain requirements or certain standards. So there we have it. So it was introduced in 1985 by the Nasdaq Stock Exchange. So let's move on. So now let's look at the major companies which are found in the Nasdaq 100. Okay, so we have Apple, and like I said, these are listed according to their market capitalization, and market capitalization changes. So this could be an odd chart that I'm just using. All right, but market capitalization changes. All right, but Apple has been dominating when it comes to the market capitalization. I'm sure it is now hitting about $3 trillion US in market capitalization. All right, so followed by Microsoft, then Amazon, then Tesla, Alphabet Inc., which is Google, and also Nvidia, Meta Platforms, etc., etc. So there are quite a lot of companies which are listed on the Nasdaq Stock Exchange, but these are the major ones. And in most cases, whenever we are trading the Nasdaq Stock Exchange, the Nasdaq 100, we normally look at these companies and seeing how they are performing, because whatsoever happens with these companies, definitely it will affect the performance or the overall performance of the index. Okay, so this is where we end in this lesson, and I will see you in the next lesson. Hello there, welcome to this section, which is section 2 of our course on how to trade US 100. Now, in this course, I'm going to explain to you everything fundamentals, or the fundamentals that you need to know when it comes to trading the US 100. Now, listen, the US 100 is one of those indices that is quite easy to trade, and that's probably the reason why a lot of traders are departing from currencies into this index, because it seems like the information that you need to trade it effectively and profitably is available, or like it is almost everywhere. All right. Now, I'm going to introduce you to 3 websites. 2 of them are also in form of application which you can download from Google Play Store, and also App Store. All right, you can download these 2 applications, namely CNBC and also investing.com, and you are going to follow the approach that I'm going to give you in this section and in the lessons that follow. So there are 3 important websites where you can get this information, and it will help you fundamentally, all right, to know what to expect in the market, because the US 100 is so much driven by the fundamentals. All right, so if you don't really know what is really affecting the market, where the buys are coming from, where the sales are coming from, you are going to be so much overwhelmed by the performance and the behavior of this market, to a point where you think, hey, I don't understand how to trade this market anymore. And my goal is not to make things very complicated for you. My goal is to make things easy for you. I just want to present them in a simple way, such that it will be so simple for you to believe. Yeah, that's what I want. Okay, so I want you to buckle up, and let's dive into the fundamentals of how to trade the US 100 fundamentally. I'll see you in the next lesson. Hello there. All right. So in order to have a clear understanding of how the Nasdaq stock index work, or rather just the Nasdaq, there's a website for you that you can check out. So before we can proceed in our lesson, looking at what the Nasdaq is and how you can trade it technically, looking at the technical aspect of trading the market, etc., I just want to give you some few insight that might be of help to you when it comes to trading the Nasdaq. So Nasdaq has got a website called the nasdaq.com. So here on this website, that's where you get most of the information that you want to know about the Nasdaq Stock Exchange. So in this website, they're listed Nasdaq Nasdaq 100 index, all right, and other assets which are traded in the US, or which are based in the US. All right, so here we have the website. So you can just go to nasdaq.com, and this website is going to come. So here it gives us the trading hours for the Nasdaq Stock Exchange. So the Nasdaq and the New York Stock Exchange trading hours are as follows: Monday through Friday. So the market opens from Monday through to Friday. All right, so the Nasdaq Stock Exchange opens at 9:30 a.m. That is the Eastern Standard Time. All right, that's the New York time, Eastern Standard Time. So you can get this time and then convert it to your own time. Then it will give you what time exactly the market opens. All right, and then it closes at 4 p.m. Eastern Standard Time. Again, you can get this time, the open and the close, and then you put it into your whatever time zone that you are in. All right, so if you are UTC +2, UTC +3, whatever time zone that you're in, then you can convert this time so that you know exactly when the market opens and when the market closes. So same with the New York Stock Exchange. All right, so there's the open at the same time. All right, so now apart from this, they are holidays, all right, where the market will be closed. All right, so there are 9 market holidays in a year when markets are closed, meaning that when there's no activity on the market. And what are these holidays? Because you need to know them, it's important. All right, because there'll be certain days where you just going to realize that there is no activity on the chart. You're looking at the chart, maybe you're pumped up to trade the market, and then you realize the market ain't moving, the market is not moving, and you're wondering what could be the problem. You just have to also be aware of the fact that there are holidays that will affect those trading times. All right, so we have the New Year Day, okay, New Year's Day. Definitely on New Year, the market is closed. Then we have the Martin Luther King Jr. Day, the market is closed. Then the President's Day, the market is closed. Good Friday, market is closed. Memorial Day, market is closed. Independence Day, market is closed. Labor Day, Thanksgiving Day. Like today, I'm recording this video today, or I'm recording this lesson today on Thanksgiving. All right, so the market is not very much active. All right, so I can show you quite all right, the market is moving, but there isn't any form of volatility. So if you can see, nothing is really going on. Nothing is really going on. This was the move for, I think, for Wednesday. Since then, yesterday, you can see the market has not been doing anything. All right, and it's because of the Thanksgiving Day. And then also the last day is Christmas. All right, so these are the days in which the market is not going to move. So how many holidays in which the market is closed? We have 9 holidays. Now, this is apart from Saturday and Sunday. And of course, Saturday and Sunday, we know that the market is opened from Monday through Friday. So meaning that Saturday and Sundays, the markets are not open. So the markets have holidays may also include July 3rd and July 5th, the day after Thanksgiving. All right, so which is today is the day after Thanksgiving. Thanksgiving was yesterday. Yeah, Thanksgiving was yesterday, but today is also not so much volatile because it's the day after Thanksgiving. Or Christmas Eve, the market also is not going to be volatile. So depending on how the calendar falls in a given year. In that case, Nasdaq will close at 1 p.m. Now, this 1 p.m., remember, it's Eastern Standard Time. So you need to convert that one to your own time, meaning that what time is that? So in my region, 1 p.m. should be somewhere 7 p.m. That's my time. So I know that once the market opens by 7 p.m., 8 p.m., the market should close according to my according to the region where I am. All right. So you can also this is very, very, very much important that you understand the times. All right, because you don't have to be caught up on the wrong side of the market. Now, apart from that, we have what we call the extended hours of trading. Now, why is this important? Because the Nasdaq offers about 3 trading hours. We have the pre-market, we have the pre-market, we have the post-market, and then we have the extended hours. All right, so pre-market, post-market, extended hours. Remember this: pre-market, post-market, and what? Extended hours. So now let's look at what each one is. So the extended hours trading, there are also pre-markets and after hours trading sessions available, also known as extended hours. So the pre-market is when the market is open, all right, the trading session that is offered before the actual open of the market. All right, so that one is actually very important. And what is that pre-market? So the pre-market one will begin from 04 a.m. until 9:30 a.m. That is the Eastern Standard Time. So this is the pre-market trading hours. So you need again to get this time and find out exactly what time is this on your time zone. All right, because that is very much important. Find out what that time is on your time zone. All right, so for me on my time zone, 4 a.m. should be somewhere 10. All right, 10 a.m. all right, up to 3:30 p.m. Okay, so if there is what they call daylight saving, then this is going to be somewhere 11 a.m. up to 4:30 p.m. So that is the pre-market. All right, that is the pre-market. So that during that period, the market will be offering some trading opportunities because during that period, the market will be moved so much by the London session. All right, so in the London session, the market will be offering such opportunities which you can take advantage of. All right, so then when we look at the after hours, all right, the after hours, okay, so remember pre-session, post, and then after hours. So the after hours, what does that mean after hours? So after hours is when the market closes. All right, so certain brokers have different pre-market and off and the after hours. So different brokers offer different pre-markets and also after hours. All right, so after hours trading times, for example, TD Ameritrade limit pre-market trading between, which is AM and 9:15 AM. All right, so you can see that one. However, when now we talk about the after hours run, okay, they run from 4 p.m. to 8 p.m. Eastern Standard Time. So this is after the market closes. All right, so in my time, okay, 4 p.m. could be it could be 11 p.m. All right, so 11 p.m. to somewhere 02. All right, so those are after hours. Okay, but then the market does not close. So what closes is the stock exchange. All right, what closes is the stock exchange. So you may also observe that even as the stock exchange has closed, there will still be movement in the market. Yes, there will be movement in the market because initially the market does not close until Friday. Remember, the market opens Monday until Friday. But those active sessions of the market, all right, where there is volatility in the market, where there is volume in the market, that one happens between 9:30 a.m., all right, 9:30 a.m. to 4 p.m. All right, so from 9:30 a.m. to 4 p.m. So from 9:30 a.m. to 4 p.m. So during this time, this is when there is volume in the market. This is your most active time. This is the time when you're supposed to be active in the market. All right, because there'll be a lot of trading opportunities that is going to be offered to you during this time. All right, so remember 9:30 a.m., which is Eastern Standard Time. All right, so this one is EST, so Eastern Standard Time. Now convert this one. So like in my region, during this time, it has to be 3:30 p.m. All right, 3:30 p.m. to 11 p.m. All right, that is in my region. So to 11 p.m. So 3:30 p.m. to 11 p.m. All right, so I'm active on the chart during this time. All right, but that does not mean that I'm not active on the chart even, during the pre-market. I am, but I am more active during this time. Why? Because at 9:30, when the market opens, we see a lot of volume come into the market. And it is during that time that there'll be a lot of opportunities. And also it is during that time that a lot of people also tend to lose a lot of money. on the market. So you need to do your analysis very well. You need to look at your technicals very well. You understand your fundamentals very well before you jump into the market. Now let's continue and look at other things that can be seen. So now, what else can we get from this website? Like I said, quite a number of information is shared. So already you'll be able to know what the market is doing just by looking at, because this is the Nasdaq chart. All right. So this is the Nasdaq chart. All right, which shows you how the market has been performing. All right. So if this whole chart is green, then you just have to know that the market is in a buying spree. Right, the market is buying. If it is red, then just know that we are selling. So you can have some pre-data, all right, based off what the market is doing and based off just looking at this chart. You can also get some news from here, all right, based off what the market is doing, etc., etc. So these news events will be based off maybe the Nasdaq. So you can see US stocks. Wall Street ends up before holidays. So Wall Street ends up before holidays. Investors optimistic, Fed done, rising rates. So with this information, you would obviously know what to expect next. All right, what to expect next. So same here. Wall Street climbs before holiday. Investors optimistic, Fed done, hiking rates. So we know that next week, as the market is going to open, I know what to expect from the market. So I know that the market will be pushing to the upside. You get it? I know what to expect. So this information, you can get this information on the same website. It will help you to be able to be on track fundamentally. All right. It will help you to be able to be on track fundamentally. All right. So that is it about this index. And you can see quite a lot of information that you can really capitalize on with regards to this market. All right, so you can look at stocks, different things that you can look at. All right, you can look at quite a number of different things and how stocks are performing, etc., etc. All right, but the major thing and the most important use for this website is just to help you track the Nasdaq, because there's so much information that you can just get from this website that is going to help you to analyze the market effectively. So you can see here we've got the Nasdaq composite, all right here. Then we have the NDX, which is the Nasdaq 100. So you can just look at these numbers and say, okay, we are positive, we are bullish. So if this is happening in the pre-market, remember the time before the market opens, then you'll be able to know at least beforehand where the market is going to go. So you would be able to tell, looking at this number, if we are up 67 points, all right, in the pre-market, then the possibility that we might even go up, all right, when the market opens is very high. So this is how far the market shoot yesterday, all right. So once the market opens, this information will be refreshed and you'll be able to get the new information. But this data is able to help you to predict where the market is going next. All right, that's very important. So again, you can come here and look at the companies that like I made mention, that affect the Nasdaq so much. So you look at Nvidia, Tesla, Microsoft, Apple, this is AMD, that's Amazon, Meta, Google. So you can see out of all these companies, only 3 are red, the rest are green. So already we can tell to say, based on this information, if the rest are buying but only 3 are red, then the possibility that the market is going to push to the upsides very high. All right, so just this website alone, you are able to tell what is going to happen. Not necessarily that you take this information and then you go to the chart and you start clicking on those bytes. That's where the technicals comes in handy. I'll see you in the next lesson. Hello there, welcome to this lesson. Now, in this lesson, we are going to look at another website which is as important as the Nasdaq website. So this website helps you also to understand the fundamentals of the Nasdaq, all right? Because again, it is important to know that Nasdaq is so much driven by fundamentals, all right? Fundamentals move the Nasdaq so much. Why? Because, if you don't understand the fundamentals, both the micro and the macro, you won't know why the index is behaving the way it is behaving. All right, so with this website, you can also download the app. The app is available on App Store and also Google Play Store. You can download this one and install it in your phone. You will need it because of what I'm going to explain to you now. All right, so now let us look at what this website offers. So if you come here on these three lines, right, and you can see that we've got markets. Under markets, we've got pre-markets, US market, China markets, European markets, Asian markets, you know, different markets here. All right, so we can go to the pre-market. If we go to the pre-market, it will show us what activities are going on before the market opens. So you can see pre-markets, US, America, Asia, and Europe. So of course, you can look at all this information, all this data, but then all this data is not so much important for now, because I think for me, the best way I look at the pre-market is when I look at just the actual market, like here. All right, so if we come here, you can see there's pre here. All right, so if I click on this one, it takes me direct to the US markets. So from here, I'm able to see the Dow Jones futures is buying, the S&P future is also buying, the Nasdaq future is well, it is undecided, not yet decided where to go. All right, so based on this information, I know if this one is buying, then definitely also this one has to be in a buying spree as well. Why? Because these assets are almost the same. So you can even come to the chart and look at what is happening. So of course, we can see that obviously because the Nasdaq is red, because of this selling, the selling which is going on right now. But then based off the technicals, I'll be able to tell that very soon, if today was a good trading day, then as the market opens at 9:30, all right, Eastern Standard Time, which is 4:30 p.m. my time, then I would know that, all right, we are going to be buying the market. All right, so this is the pre-market, right? This is the pre-market. Now, once the market opens, all right, we are going to have the actual markets, all right, the actual markets, and we can compare information from pre-markets to actual markets. But then pre-market gives you the idea of what to expect once the market opens, all right? Remember, pre-market is important. The activities of the pre-market may directly or indirectly affect the activities of the market when the market opens. All right, so you need to understand what is really going on here to have a bias. So if I look at all these futures to be green, or if they are red, then I'll have a bias as the market is going to open in the open of the market at 9:30 Eastern Standard Time. So here is an important information. The other important information that you can see is that here you see Dow closes nearly 200 points higher Wednesday as market head into Thanksgiving. So the last recorded activity of the market was on Wednesday, and market pushed very hard, 200 points. That's quite a lot of points that the market made. All right, so whenever you hear Dow Jones, Nasdaq, they're just one and the same, because these assets, that's the US 30 and that's the S&P 500 and the US 100, they move almost the same way. All right, so sometimes if you hear the Dow Jones, sometimes they'll say Nasdaq has gained 2%, 3%, Dow Jones has pushed 500 points. You'll find that if the Dow Jones is buying, the Nasdaq will also be buying, and the S&P 500 will also be buying. Why? Because these indices share the same companies. So you find that most of the companies which are the movers of the Nasdaq are also found in the US 30, are also found in the S&P 500. So the S&P 500 is what they call the Fortune 500 companies. All right, so the S&P 500 will also have almost all the that's the index which has entirely more companies than these two other indices. All right, so find that that's why you see a correlation in terms of how they move. So just to show you, just to give you an example, let me just add a comparison right here. Okay, so trying to compare, let's say US 500. So this is the S&P 500. So now let's try to compare it. So you can see that almost they move in the same way. So even if I took it to the daily, you still see that the movement is the same. So if one is dropping, the other one will also be dropping. If one is rising, the other one will also be rising. You get it? So if one begins to drop, again, the other one will also begins to drop. If one begins to rise, again, the other one will begin to rise. Okay, so they move the same. So again, if I can get the US 30, you will still see that they are just the same. So let me put the US 30 there. Okay, so this is the US 30, the blue one. So you can see that they move almost the same. So when they say the Dow has gained 500 points, just know that all these indices were buying. All right, now that gives you an information, an insight into what is going to happen next in the market if the market closes up. All right, so may expect that the next move the market will make tomorrow, it will also be a buying move. All right, so if they close lower, then we expect that maybe they might continue to sell even the following day. Now let's go to the US. So from pre-market, we can now go to the US market. Now these are actual markets which are now closed. All right, the pre-markets, it shows us the futures, what the market is doing before the actual market. So when the market opens, we are going to be focusing on this US and then comparing it to the pre-market. So you can see that the market closed 200 points. Look at how high Dow Jones went, 184 points. That's almost 200 points. Look at how S&P 500 went, also 18 points. Look at how Nasdaq closed, 65 points. All right. Now, these numbers are calculated from the open of the market, not from the pre-market. All right. So you have to have know that difference. All right, they are not calculated from the pre-markets, they are calculated from the close. So the market closed 184 points. So when the market opens, let's say tomorrow, I mean not tomorrow, but Monday, when the market opens on Monday, you see that this number, they'll start a fresh calculation from this number, but then this number can give you a heads up of what to expect when the market opens. All right, so what I'm going to expect when the market opens on Monday is a buying spree. All right, so I'll be expecting the market to be buying based off how the market closed. So I have to be in touch with this website in order for me to be updated on everything that is happening in the market. Now, again, we looked at all these markets. We looked at the pre-markets, the US market, etc., etc. You can also have information about tech. All right, so you can have information about tech and you'll be, having those updates on what is really going on, all right? How Meta could benefit from the open AI shakeup, etc., etc. So this information, if it is good for a tech company, then just know that, okay, something is being cooked and we may expect the market to push to the upside. Again, the information is also right here. So you can check up different types of tech information right here. Okay. All right. So the last thing that you need to do with this website is also to create what we call what's this? You can create what we call the watch list. All right. So you can come here on your right, on top here, and you can create your watch list. That is, if you're signed in, then you can then create your watch list. So I have my watch list with me. So this is just for the Nasdaq. All right, so this is just for the Nasdaq. So I have Oppo, Apple, Google, Meta, Netflix, and Amazon. All right, I should have Tesla. All right, Tesla as well. So the watch list helps you to keep on track what the companies are doing. So let me just try to sign in and see if I'm going to have an updated watch list. Yeah, definitely. So you can see I have these companies that I keep on watching to see how they are performing, because these are one of the biggest companies in the Nasdaq stock exchange. And of course, I can see how the market closed, all right? And I'll be able to say, okay, with this information, I'm expecting a buy or I'm expecting a sell. Then I'll wait for the market to get to a certain level where I would like to get into the market or like to get involved into the market. Okay, I'll see you in the next lesson. Hello there. So here, I'm going to also show you the last website that is quite important with regards to fundamentals. I don't want you to get bored with the fundamentals because you need to understand what exactly it is that moves these markets. All right. So Nasdaq is heavily fundamental. So if you want to trade any index like the US 100, the US 30, you need to also be well vested with the fundamentals. All right. So here we are on this other website, which is quite important. It's called investing.com. So investing.com, we are going to go to the news, and then the news, we go to economic calendar. Now, after we get to this economic calendar, right here it is, you can see there's so much information that is listed, all right? So this is where you can capture the news events that are listed from different companies, or I mean, not different companies rather, but from different countries, all right? So this one talks so much about what is going on in the country and how that news is able to affect the currency of that particular company. Okay, now, what we're going to do right here is that we are going to filter out this news because it is not needed. We don't need this news at all. All right, so we're going to filter it out. Then we're just going to remain with the news for the US because the index that we are trading is from the US. So we don't need Brazil, we don't need Europe, we don't need Canada, we don't need Japan, we don't need, Swiss franc, we don't need all this information, right? So what we just need is the US. So how do we filter this? So we can come to filter right here, and then we can unclick or untick or clear. Let's just clear all, and then we come to the US, and then once we find the US, then we can click on the US. Then we come down here. What are we looking for? What type of news do we want? We want employment, the credit balance. We want economic activities, central banks. We want inflation and confidence. I want this. Okay, we click all these categories. Then we come to importance. We only want the 3 bulls or the 3 stars. So the 3 stars shows how important the news is. All right, the level of impact of that news. All right, so this is the highest level of impact of that news. Medium impact, less impact. All right, so this could be 3 bulls or 3 stars, whatever. Okay, but if you look at them critically, they are like, most important. It's about the impact of this news. All right, then we can go to apply. Now, after we apply, then we come back here. You can see that right now we have the holiday. All right, so United States Thanksgiving. So let's go, maybe let's take a month. All right, from here to 24th or to the 31st of December. Let's apply that information. Now let's look at the news that are important that you need to pay attention to. All right, news that will move the Nasdaq. So number 1, we have consumer index. It does move the market. We've got the GDP moves the market. We've got the core PEC price index does affect the market, but not that much. All right, so we've got Fed chair. All right, Fed chair Powell speaks. So when this guy is speaking, when he's talking, all right, this man can affect the market very high. So you need to listen to what he's going to be saying, and you need to listen. All right, you need to customize your investing.com. You choose your time zone. All right, so here it says time zone. All right, so mine has already been set. Okay, so you choose your time zone. So let me say if it is Eastern Standard Time, you can see this is the Eastern time. So everything that you see here is Eastern Standard Time. All right, so now what you can do is that you can come here, like in my zone it's GMT +2. All right, so I'll come to GMT +2. Then I'll add it there. Then the time will change. Then I'll know when that news is going to come. So when Paul will be speaking, it will be somewhere 18, which is 6 p.m. my time. So you can look at all these news events. That do we have any important news events here? The non-farm payroll is very important. You need to watch out for this one. very important. The CPI, extremely important, because this one tracks the inflation rate in the US. All right. So if the CPI is very high, we expect the market to go down. If the CPI is low, we expect the market to go up. All right. Same with the PPI. If PPI comes out negative, the market will buy. If the PPI comes out positive, the market will sell. So also the interest rate decision. All right. So if the interest rate comes out positive, or they increase the interest rate, the market will shoot down. Okay. Yeah, so this is the information that you need to look out for. You need to look at the numbers. All right. So let's say for instance we go to the CPI. So while we are going to have the CPI, we're going to have the previous, then the forecast, and the before. So we're going to have previous, then they'll give us the forecast, what they are forecasting, and then the actual. So if the previous, let's say the previous year, the actual here, then the forecast here, the actual. So here they were saying that the CPI could remain constant. However, the CPI came out less. So this led to a huge buy in the market. And I can show you what happened. Let's go to the Nasdaq. And I believe we need to remove all these things. Okay, so all right. Let's remove this. Okay, so let's go to the Nasdaq, maybe just even on the 1 hour. Let me just show you what happened on that particular day. Remember, you need to remember the day. When was it? Let's go back. It was on the 14th of November. So what happened on the 14th of November here? All right, so the CPI came out negative. It came out lower or lesser than what they were expecting. Hence, the market just shoot. You see, so once the CPI goes down, the Nasdaq goes up. All right. And if the NFP also goes down, the Nasdaq goes up. All right. So there also, when was the NFP? Was it somewhere here? Okay. All right. So we need to find when the NFP was, and you see that when it should be right here. All right. So when the NFP was negative, the Nasdaq was positive. All right. So these are more like negatively correlated. All right. Negatively correlated. So let's look at again the month, and let's look at from November 1st to November 30th. Okay, so let's look at the NFP. I'm more interested in the NFP. When was the NFP? It was on the 3rd. All right. Was it on the 3rd? Yep, it was on the 3rd. So look at this number. They were expecting that the jobs will be 180K, but the actual figure came out to be 150. So from the previous, they expected the number to drop, hence it dropped further. All right. So what does that actually mean? All right. So if we go to that actual day on the 3rd of November, 3rd of November should be right here. So you can see then how the NFP pushed to the upside. So this was all NFP, right? That led the market to the upside. So it's very important that you get into this and you study your fundamentals very well. So this website will help you to know what is really going on with the fundamentals, when to be on the market. If you're not good at fundamentals, you'd rather avoid trading when there are these news events. You'd rather wait for these news events to go, and then now that's when you get into the market. All right. Yeah. Okay, so that's that. Then let's get now into the real thing. Let's get into the technical analysis of the US 100. Hello there. I believe you had some good time when I was sharing with you the how to trade the US 100 fundamentally, or how to analyze it fundamentally, how to look for the information which affect the market, how to use the 3 types of websites, namely the nasdaq.com, the CNBC, and also the investing.com. I believe you had a good time, and you know how to look for the information that pertains to the Nasdaq. Now, in this section, we are now going to get into the other aspect of trading, because knowing the fundamentals alone is not going to help you become a consistently profitable trader. Okay, so it is when you combine the fundamentals and the technicals, because the technicals are going to help you to know when to enter the trade and when to exit the trade based off your fundamental analysis. So technicals, we are going to delve so much into when you can take a trade, when you can exit the trade, etc., etc. Because whenever we look at the technicals, we're just looking at history. All right, we're looking at what happened in the past, and if is what happened in the past going to repeat itself in the future. So we use past information to project future events. That's what technicals is all about. So we're going to look at candlestick analysis. For me, candlestick analysis is one of my favorite concept, or rather favorite part of trading, because many traders have undermined the candlestick. They just want to go to the complicated stuff. And that's the reason why they make such losses. All right, they are not consistent in their trading. So keep it simple, and that's it. All right, so if you are able to understand candlesticks and candlestick patterns, then welcome to the club of being consistently profitable, because everything that we're going to discuss will build on the candlestick pattern. So I'm going to present to you the candlestick analysis, then we're going to look at the market structure, then we're going to look at just some technical analysis of how you can now, be able to analyze the chart, plan your trade, the steps that you need to follow in order to plan your trade, and also enter and exit your trade, etc., etc. So I'm just going to give you two things that I do whenever I'm trading. All right, I don't look for too many things. I'll just look for two things, and those are enough for me to take a trade. All right, so come with me into this section and let's dig deeper and see how you can technically analyze your chart. I'll see you in the next lesson. Hello there. So in our previous lesson, we were looking at candlestick patterns and how you can take advantage of candlestick patterns to explain, or rather to anticipate, the move of the market. That was so great. Now, candlestick patterns are found on every time frame, because the chart is made up of three types of charts. We've got candlestick charts, line chart, bar charts, and there are other type of charts which also exist. But the commonly used one is the Japanese candlestick, and Japanese candlestick carry so much information that we need to understand and also build our strategy on. All right, so we looked at different types of candlestick patterns. We looked at the bullish engulfing, we looked at the pin bars, we looked at the hanging man, we looked at the doji, the spinning top, we looked at the morning and the evening star, we looked at the harami pattern, which is also known as the inside bar. These were the major candlestick patterns that we looked at. Of course, there's so many other type of candlesticks, like the marubozu. Right, marubozu candlestick. An example of a marubozu is, let me just draw it somewhere right here. So it's a candlestick that has a huge body with a small upper and a small lower wick. So that is a marubozu. So an example of a marubozu could look like this. All right, let me just draw it in the best way that I can. Okay, so I'm going to make this one a little bit thicker. Also, I'm going to make it green. Okay, and I will also increase its color. All right, the intensity, so that it matches. Okay, so that is how a marubozu candle is going to look like. Okay, so it's going to look like this. Okay, so you can see that this candlestick has got so much momentum. All right, you can see how big the candlestick is, and also we can also have a bearish marubozu. Bearish marubozu will look like something like this. Okay, this is going to be a bearish marubozu. We're going to have an upper wick, then also we're going to have a lower wick. Okay, so these must be turned into red. Okay, so let me just shift them. Red, and this one also red, and then also this body is going to be red. Okay, so here we have two types of candlesticks. We have the marubozu, right, candlesticks, and these are known as momentum candles. All right, these are known as momentum candles. Do I have any any two that I can use right here. All right, they're called momentum candles. Okay, all right, so they're called momentum candles. So you can see that once we have a big green candle, all right, in my case they are blue, all right, meaning that buy is for green represent blue on my chart and red represent black on my chart. Okay, so based off these candlesticks, if I have this green candlestick printed on the chart, all right, I'm able to anticipate where the market is going to next. All right, just by looking at this candlestick, I'm able to anticipate that the next candlestick is obviously also going to be green. That will be my anticipation. Why? Because I'm looking at what happens with the previous candle. So if the previous candle closed bullish, it means buyers are interested in pushing the market to the upside. Yeah, buyers are interested in pushing the market to the upside. So I'll anticipate the next candle also to be blue. To be green. All right. So based off that, I can even plan my trades based off that. So if this is a daily candle which goes as a bullish candlestick, then I'll be able to tell where the next candlestick is going to be. All right. Now again, if the market if the next day the market opens, all right, and closes as a bearish candle, all right. So if the market closes as a bearish candle, all right, to me, that is also a signal that sellers are interested in getting involved in that market. All right. Sellers are interested in getting involved in that market. However, they were not strong enough to take away the buyers. All right. So this then is going to form an inside bar. So inside bar, all right, I'll still be looking at this area right here. I'll still be looking at this area, and also I'll still be looking at that high right there. Okay, so my range will be this one. If this is a daily candle, my range will be this one. Now, based off this type of analysis, just looking at candlesticks, what do you think will be the next move of the market? Sometimes we tend to become so, over technical that we start over analyzing the market, wanting to see, okay, where is the market going? Where is the market coming from, etc., and all those things, without looking just at candlestick patterns. Remember, in our previous lesson, we learned that candlestick patterns are a language of the market. So by you just looking at the candlestick patterns, you are able to predict where the market is going and where the market is coming from. It is the chart talking to you, all right, giving you that information, telling you, hey, this is what is going on right here. Okay, so in most cases, when I see this, all right, for me to be convinced that we have to sell, all right, I'll have to see another candle, which then breaks the low of the previous candlestick, which was the bullish candlestick. So once we break the low, then for me, we are now bearish. All right, for me, we are now bearish. And then what I'll start looking for or expecting, or rather anticipating from the market, is price must continue to the downside. All right, now that we have broken below the previous low of the candle, that is going to be a signal to start selling. So whatever time frame this is, it could be a daily, it could be a 4 hours, it could be an M15. All right, for me, that is a signal. All right, so if this is happening from an area of interest, then that to me is a signal. Okay, but also just having that information alone is not enough, because once I have this one, the possibility that the market can just open right here and push to the upside and give us those green candles is very high. All right, it's very high. Okay, very, very, very high. So we don't have to underestimate this possibility also from happening. We don't have to underestimate it. We need to expect that such kind of a possibility can also show up in the market. All right, and once that happens, then do you know what next? The next thing to do is to start looking for buying opportunities. So the moment this candlestick closes, all right, what am I going to do? I'm going to take my entry, put it right there. My stop loss can just put the reasonable amount of pips, and I'll target my 1s to 3, because I know that based on how this market moves, I know that it'll be very much possible, the possibility that the next candlestick that opens, all right, the next candlestick that opens will shoot to the upside. Very high, all right? Very, 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 very high, that the next candlestick is going to shoot to the upside. And yeah, very, very high, all right? So based off this, I know that I can count on this kind of a setup. I know that I can count on it, all right? Why? Because we broke out of this area. Okay, we broke out of this area. Okay, so now this is what I'm going to show you, and this is what we are going to look at. Now, before, again, we get deeper into the chart, I want us to just continue a little bit on the how support and resistance is formed and how you can also be able to analyze support and resistance based off candlestick patterns. Now, let's get into the next lesson for me to explain this. Welcome to this lesson. Now, in this lesson, we are going to look at the candlestick anatomy. Candlestick anatomy. Now, candlestick anatomy, this is the study of a candlestick. We are going to look at what a candlestick is made up of and how we can interpret the message which the candlestick is communicating. Now, we're going to start with a bullish candlestick. So what we have here, the green one, is called the bullish candlestick. Now, you can customize this candlestick according to the color of your choice. On my chart, you will observe that bullish candlesticks are blue, while bearish candlesticks are black. And that is the color that I chose. That's how I decided to customize my candlestick. For my chart. Now, let's begin. A bullish candlestick is a candlestick that shows the buyer's activities in the market. So every green candlestick, when a green candlestick is being printed on the market or on the charts, that shows the bullish momentum. That shows that buyers are in the market. So it shows the buyer's activities in the market. Whereas when you see a red candle being printed, it shows the activities of sellers. It shows the presence of sellers or the presence of buyers in the market. Now, candlestick is the language of the market, meaning that if we want to understand what the market is doing, then we have to be able to study and look at what candlestick are doing or what type of candlesticks are being printed on the charts. Now, let's begin. So every candlestick has the opening price, it has the closing price, it has the high, it has the low, and it has the body. So these are the parts which makes up the candlestick. All right. So here, looking at the bullish candlestick, the bullish candlesticks will open lower because the goal of a bullish market is to take prices higher. So the bullish candlestick will always open lower. So here, down here, this is where you're going to find the opening price. And then this vertical line down here, it's called the lower wick or the shadow. It helps us to understand how low the price went before the buyers decided to take the market to the upside. The green shaded area or the green shaded region, it shows the body. It shows the momentum that was in the market. It shows the amount of volume that was dispatched in the market. So this body is what now enables us to tell whether the market is heavily bullish or it is heavily bearish or the market is not doing anything. So the proportion of the body to the wicks is also what is going to help us understand who is in control of the market, whether buyers are in control of the market or bears are in control of the market. So the market has a body. So from the open, price will push all the way to the upside. And then this upper vertical line also represents the upper wick. All right. So it shows us how high the market went before sellers came in and rejected higher prices and decided to close higher. All right. So as we can see right here, the close of the price for that particular trading session is far away from the open, meaning that there was so much bullish momentum in this candlestick that enabled the price to even close higher. So whenever you see this kind of a candlestick, you know that, okay, what is really happening here is that the market is being heavily bullish, and the probability or the chances of the next candlestick opening and pushing the prices to the upside are very high. All right, so let's get to the bearish candlestick. Now, bearish candlestick also has the open, the close, the upper wick, and the lower wick. Now, the only difference is the open is higher than the close. And what's the meaning of that? It means bears open higher and they close lower, which means they want to take the prices down. Okay, so as we can see here, the market opens, then this upper wick here, or the vertical line which goes to the upside, it shows the rejection of higher prices by sellers, meaning that at one point buyers decided to take control of the market, but sellers came in and, you know, decided to push the prices down. So this week it shows how high the market went, or how high price went before it was rejected down and price was pushed to the downside. Okay, also here, it shows how low the market went, all right, by this lower vertical line. It shows how low the market went, all right, or rather price went for that particular trading session before buyers decided to at least push the market up higher by creating, you know, this lower wick, and they decided to close lower. So you can see that the close is far away from the open, and this then tells us that, you know, the market is going lower. So based off this type of a candlestick, you may be able to predict and may be able to know where the market is going to go next. So understanding candlestick patterns and the message that candlesticks are giving you is very, very much important, because it will also help you to know who is in control of the market, whether buyers or sellers. And also that is going to help you when it comes to making the trading decisions. Okay, so I will see you in the next lesson, where we're now going to dive deeper into candlestick patterns, and we're going to look at different types of candlesticks and what they mean. Welcome to this lesson. Now, in this lesson, we are going to look at different types of candlestick patterns. Now, there are different type of candlestick patterns. We can't just manage or afford to go through all the candlestick patterns. However, if you have time, you can do your own research and, you know, try to find out different types of candlestick patterns. The ones that I'm going to show you here are the ones that are, you know, oftenly used, okay, if I may use that word. These are the candlestick patterns that are more common and easy to identify, and most of them are reversal candlestick patterns, except maybe just for one or two, which may be for continuation purposes. Now, we're going to look at the engulfing patterns, then we're going to go to the pin bars, and then we'll finish off with the evening star and the morning star. All right, so let's begin with the bullish engulfing. So what is the bullish engulfing? Number one, a bullish engulfing is a bullish reversal pattern. This signifies the end of a bearish momentum and the beginning of a bullish momentum. It signifies the end of a selling pressure and the beginning of the buying pressure. Okay, so what usually happens is that as the market is pushing to the downside, you know, where the market may be creating lower lows and lower highs, as we discussed when we began to look at the market structure, then the market hits an area of interest. It could be a support, it could be a supply, but let's say the market hits that area of interest. So the moment the market hits that area of interest, then what happens? We begin to observe that the selling pressure has been reducing, or the selling pressure begins to reduce. So as the selling pressure begins to reduce, we begin to see that the candlesticks that are now being printed begins to become smaller and smaller and smaller, signifying that the selling pressure is beginning to reduce, or sellers are beginning to lose ground and buyers are beginning to come into the market. Okay, so the signal that we're going to get around that area, okay, it's if the market gives us a candlestick that is going to be larger than the previous candlestick. Let's say the market gives us a bullish candlestick that is larger than the previous candlestick, then it is called a bullish engulfing. Why? Because it has engulfed the previous candlestick. So the candlestick that was created, let's say the bearish candlestick that was created now has been completely covered by the bullish candlestick. That already tells us that now sellers are losing it and buyers are coming into the market. So this bullish candlestick, it shows the bullish momentum that is coming into the market. It shows the bullish volume, all right, that is just come into the market. And once you see that signal at an important area of interest, number one, it could be a demand zone or it could be a support. Once that type of a pattern shows up, just know that buyers are now getting into the market. And of course, you may start looking for buying opportunities. But of course, you need to wait for the candle to close first before you start making those trading decisions. You don't just have to jump into the market and you start buying the market right away. No, you have to wait for the engulfing candlestick to close, and then that's when you can start taking the entry. Now let's look at an example of a bearish engulfing pattern. So a bearish engulfing pattern is just like a bullish engulfing pattern, except that this one is happening at resistance, or it is happening at supply zone. So let's say the market has been pushing impulsively, creating higher highs and higher lows. Then around an area of interest, which could be a resistance, we begin to observe that the candlesticks are now beginning to deplete, or the momentum of buyers is now beginning to reduce. And that can be observed by how candlesticks begin to form around that area. So you can start seeing smaller candlesticks begin to form around that area, and then immediately is followed by a red candlestick, which is bigger than the previous candlestick. So once that red candlestick is formed, which is bigger than the previous candlestick, that red candlestick is an engulfing candle. All right. Why? Because it completely covered the previous candlestick. So this one tells us that, number one, it is a reversal. It's a bearish reversal pattern. Then number two, it signifies the dying pressure of the buyers and the emerging pressure of the sellers, meaning that money now is exchanging hands from buyers to sellers. Buyers are beginning to lose steam, or rather beginning to lose their buying pressure, and sellers are beginning now to take over the market to start pushing the market to the downside. So the areas where this has to be identified, it should be at an area of interest, not just anywhere, but it should be at an important area of interest. It has to be at a level which is a significant level. So once you see this kind of a candlestick, it is a signal that a reversal is about to happen, and you can start preparing yourself to take a sell, all right, upon the close of an engulfing candlestick. So you have to make sure that the candlestick closes as an engulfing. All right, so now let us go to the pin bar. Now, when you look at the pin bars, I've got two types of pin bars with two different colors. Why? Because each color is significant. Remember, colors are very important when it comes to identifying your candlesticks. Now, let's begin with the bullish pin bar. Now, pin bars are also known as a hammer and a shooting star. So a bearish pin bar is known as a shooting star, whereas a bullish pin bar is known as a hammer. Now, why is it important to study and understand the formation of a pin bar? Now, the formation of a pin bar signifies a reversal pattern. So this is a bullish reversal pattern. So when we look at the bullish pin bar, it's a bullish reversal pattern. So we'll start with the one with the red head. All right. So the one with the red head is quite significant because it tells us that sellers were in control of the market and they were pushing the market aggressively to the downside until price hits a level. So the moment the market hits a level, what happens? There is a rejection of lower prices. It means that buyers were not willing to allow the market to keep on dropping or to allow the market to keep on going to the downside. Hence, they came in and started pushing the market to the upside. However, they failed to close the market bullish, meaning that in as much as the market was closed as a pin bar or as a rejecting pin bar or as a hammer, the color of a candlestick entails or tells us that sellers are still present in the market. All right, sellers are still present in the market because the market still closed lower than it opened. And remember, when we looked at the candlestick anatomy, we said that a bearish candlestick will always open higher and close lower. So even right here, the market still closed lower, all right, meaning that sellers still managed to close they still managed to close low for that particular trading session. All right, so in this particular type of a candlestick, there are two things that you need to do. You can either get into the trade, but you have to understand that your trade will be executed here, somewhere here. All right, that's where you're going to enter into the market. So you're going to enter because the close will be lower. So you're going to enter down here. All right, and the possibility that the next candle opening and going to the downside are very high. So in most cases, I've observed where this type of a pin bar forms, then I take a trade, but then the market continues going to the downside where it does a wick fill. What does that signify, or what does that mean? It means that maybe on the lower time frame, it might just be a pullback in order for the market to continue to the downside. This is why sometimes the color of the candlestick matters. So I won't take a trade until I see buyers come into the market. And what does that mean? I want to see the next candlestick open and it should close as a green candlestick. So let's say it opens and then it closes as a green candlestick. So that way I have a better confirmation. All right, I can now see buyers into the market that came in. All right, so in this type of a candlestick, this one is going to be more strong of a signal than just taking this one alone, more especially if it closes with a red candlestick. Now, the other type, which I wouldn't wait for a second signal for me to take a buy, is this type of a pin bar. Now you can see the difference here is that they are both pin bars, but the difference is buyers managed to close high. All right, here buyers could not close high, but sellers managed to close low. But in this case, buyers managed to close high, meaning that when the market opened right here, sellers tried to push the market to the downside, but then buyers came in and rejected those lower prices and pushed the market, took over the market and took over the entire trading session until they decided to close as a bullish market. All right, in that particular type of a candlestick, I wouldn't mind to enter after the pin bar closes. So the moment this pin bar closes, I wouldn't mind to put my buy right here. All right, so there's a difference. Okay, this one we were buying low here because this is where the market closed, but on this other one we are buying higher because the market closed higher. All right, so I believe you get the difference and you understand the difference. So it's the same way with the bearish pin bars. Now, the bearish pin bars are also known as shooting star. Okay, so let's begin with the one with the green head. Okay, so the one with the green head is just like the one with the red head. Okay, the explanation is the same. So what does that mean? It means the market was pushing to the upside. Buyers were in control of the market until price hit a level. So the moment price hit a level, it could be a resistance or it could be a supply zone. So the moment price hit a level, sellers came in and said, you know what, we have had it enough. We just don't want to, allow you to keep pushing prices higher. So we are getting into the market and we want to push the market lower. However, they failed to close low for the day, but buyers managed to close high because they opened low and they closed high. So this type of a candlestick, just like I demonstrated with this bearish type of a candlestick, this pin bar with the red head, is that we need to wait for confirmation because the possibility that the market could just go up like that are very high. So in most cases, if you just take this to say, oh, all right, it was a pin bar and I took it, then you would be surprised to notice that the market can still go to the upside and still continue pushing to the upside and hit your stop loss. And that has happened to me on several occasions where I began to question the authenticity of this type of a candlestick. So what I then did and observed is that it's better to wait for a more confirmed signal. So what does that mean? So I would rather wait for another candlestick to open and push the market to the downside. So once this candlestick opens, so now this one gives me a further confirmation that now the market is bearish and bears have jumped into the market and are ready to push the market to the downside. So there's a big difference, all right, between this one here and this type of a pin bar, because in this one the explanation is the same. It's a reversal pin bar. However, the difference is that sellers managed to close low for the day. And if sellers manage to close low for the day, it means sellers took complete dominance of the market and they managed to close low. So meaning that on this one, I can just afford to get into, because the chances that, you know, I may start seeing price pushing to the upside and going up are very slim because of how the candlestick closed. So that would be my entry, and I'll just take this entry from right here. And I'll put my stop loss, of course, above there, and I would wait to see what the market is going to do. Now, remember, these candlesticks, you just have to take them at a certain area of interest. I'll see you in the next lesson. Okay, in this lesson, we are continuing with our candlestick patterns. So here we are going to look at, again, two types of candlestick patterns, which are the hanging man, or the hanging man. Now, a hanging man is an example of an inverted bullish pin bar or an inverted bearish pin bar. Now, in this situation, what's the significance of this type of candles? These are also known as reversal candlesticks. All right, they are known as reversal candlesticks, more especially if they happen or they occur at a significant level, which could be a support or a demand. So a bullish hanging man, this is going to look like a bearish pin bar, except that it is being formed at support. So what's the significance of this type of a candlestick? Now, let's say, for instance, the market has been dropping and dropping and dropping and dropping and dropping. All right, sellers were in control of the market. Then market reaches a certain level, then we see this kind of a candlestick. All right, so we'll start off with this one, which has red head. Okay, so we see that kind of a candlestick. What's the significance of this candlestick? It shows the presence of buyers in the market. All right, so the fact that the market, the fact that the market opened right here and then price pushed to the upside, it shows the presence of buyers and the interest of buyers to push the market to the upside. So if this is forming at the support, it is a reversal pattern, and it is telling us that buyers are present. All right, even though sellers managed to close bearish for the particular day, it shows that buyers are present. So what do we need to do? We just don't have to take this candlestick to say, oh, all right, I need to just start selling, I need to start buying because buyers are present. No, we need to wait for another confirmation. Why? Because here, looking at the close of the candle, we may even expect a continuation to the downside. So if you just took a buy without a confirming candlestick, all right, then you would be taking a risk. Okay, so what I would advise you to do, as you also look from the charts, is you need to wait for the confirmation. You need to wait for the candlestick to give you confirmation. So what I would wait is to see the next candlestick turn out to be a bullish candlestick. So I want to see the next candlestick to even, engulf the previous candle. All right, so once I see this type of an arrangement formed, this candlestick is followed, this bearish hanging man is followed by a bullish candlestick, then to me that is a signal enough that buyers, quite all right, are on that level and they want to take the market to the upside. Okay, so now let us look at another example of the same hanging man. So this is a second scenario. So here you can see that the market was pushing to the downside. All right, just like this one, we are pushing to the downside. Then the market opened right here. All right, so where would the market open? So the market opened down here. All right, and buyers immediately took over the market, but they were rejected by sellers. But then the buyers managed to close high for the day. That to me is a signal that buyers are in the market, and I wouldn't even wait for a more confirmation. But of course, waiting for another candlestick is important because two candlestick patterns are better than one candlestick. All right, so it's better you wait for another one just to give you a confirmation that indeed the buyers are in the market, then you can start buying the market. So there is no reason for you to start, to try and be the earliest in the game. All right. So again, same explanation right here. Now this is just the bearish reversal pattern. So again, here the market shows that the market was bullish. All right, it was bullish, but then what happens here is that sellers, for whatever reason, decided to get into that area. It could be that the market is at a supply level, so sellers decide to jump into the market. And what happens? They push the market down, but they were rejected by buyers, but sellers managed to close bearish for that particular day. Now, this has two implications. The market might continue pushing to the upside and continue to create those, pushes to the upside. Okay, so the best thing that we can do is, although sellers managed to close bearish, we would want to wait for another candlestick, at least just to confirm that sellers are still interested in that area and they're still ready to push the market to the downside. Okay, so there is no, again, need for you to jump into the market impulsively simply because you saw a candlestick pattern. You have to wait for a further confirmation. So same applies with this one. So here, the market managed to close bullish, meaning that even though sellers were in the market by the rejection of this week, it also shows that buyers managed to close high. All right, so this then it still shows bullish momentum in the market, even though sellers were involved. But we need to get a second candle that should close, at least that should be able to take the prices lower for us to be able to say, okay, I think with this kind of a signal, I can then get into the market, get involved in the market, and then I can start looking for those selling opportunities. All right, so let's get to the other type of a candlestick pattern, which is called the inside bar. So the inside bar is known as the pregnant woman or mother and child. All right, type of a candlestick. In most cases, this candlestick is used as a reversal, and also at the same time, it is used as a continuation candlestick. All right, so let's use it as a reversal. So what is happening right here is that the market was pushing to the upside, but then, okay, for whatsoever reason, the market reached a resistance area or it reached a supply area, and then we see the presence of sellers. So this candlestick alone signifies the presence of sellers. However, you just don't have to get involved in the market simply because you've seen this candlestick. This is an inside bar. It is inside the previous candle. All right, so sometimes it may be this candle will be inside the high and the low of the candle. It has to be inside the high and the low of the previous candle. All right, so if this candle has wicks to the upside and to the downside, even if this one has the wick of this candle should not go above the wick of the previous candle. All right, so that is an example of an inside bar candlestick. All right, so this is how it's gonna be. So the moment it goes up, then it's no longer an inside bar. All right, the moment it goes up, then it's no longer an inside bar. So it has to always be inside the previous candle. Both the highs and the lows must be inside the previous candle. So what this means is that sellers have shown an interest on that particular level to push the market to the downside. But then we need a next candlestick to confirm, meaning at least the candlestick must engulf even, must close below the previous bullish candle. All right, now after we have that, then we can start looking for selling opportunities. Okay, just getting this candlestick alone may not be ideal because in most cases we have seen a situation where the market can just decide to go to the upside like this. All right, and it is then used as a continuation. So to avoid such kind of things from happening, wait for the next candle to be formed. So same applies with this one right here. So the market was pushing to the downside, then we see a small candle formed. All right, so this is an opposite type of a engulfing pattern, except that the smaller candle is found on the right side while the bigger candle is found on the left side. So this smaller candle, the bullish candle, is inside the previous bearish candle. So it is inside the previous bearish candle. So both the high, the low, and the open and the close of the next candle must be inside the previous candle. That's what makes this to be an inside bar. And again, with this type of a candlestick, what we want is, if it is truly a reversal pattern, we just want to see at least the next candle that is going to be formed as a signal to close above the previous bearish candle. All right. In that way, we are going to have a full confirmation that the market now wants to reverse. So the most important thing when you're reading candlestick patterns, you need to be very patient. You don't have to rush for anything. Wait for the candlestick to close before you can make any trading decision. Because for as long as the candlestick is still open, anything can happen. You don't have to rush into this market thinking that the market is going to leave you. If it leaves you, it's okay. You can still get another opportunity tomorrow. I'll see you in the next lesson. Okay, in this lesson, we continue looking at candlestick patterns. All right, so now we're going to look at the spinning top, both bullish and bearish. So now, what is a spinning top? A spinning top just signifies indecision in the market. So whenever this type of a candlestick forms, whether it forms at support or it forms at resistance, you don't have to take any actions yet. What you need to do is to wait for the market to create the next candlestick, because the next candlestick is what is going to give you the signal. So meaning that once this candlestick is formed, anything can happen in the market. The market can either go upside or it can go downside, because it is just an indecision candlestick and the color of it does not really matter. All right, does not really matter. So the color does not really matter. So what we want is to see the next candle. Where is it going to go? So let's say if this one is formed at resistance, there are two possibilities. The market can still break to the upside and, you know, continue giving us those higher prices, or the market can reverse and, you know, go to the downside. So this type of a candlestick, the best thing to do is to wait for a confirmation. All right, let's wait for the next candle to print. That's when we're going to know the original direction or the original intention of this type of a candlestick. So this one can either be bullish or can either be bearish. The color does not necessarily matter so much because it is an indecision candle. Now, let's also look at the gravestone doji and also the dragonfly doji. So all of these two types of candlesticks, the spinning top and the doji, they are called indecision candles. So once these candlesticks are formed, we need to wait for the next signal. However, when we see the dragonfly doji, more especially at an area of interest, this could also have or carry the properties of what? Carry the properties of bullish pin bars, which is a hammer. However, it does not have a body, and you can see the price closes where it opened. So the market opened right here, came down, all right, created the low, buyers came in, said, nope, we want higher prices. They created highs. Sellers says, you know what? No. And then the market closed where it opened, meaning that initially this is a non-trading day, meaning that price never moved, all right, because the movement of price is always indicated by the candle, all right, the candle body. So in this situation, we don't have the candle body, which also entails that the market did not actually move. So once this one is formed, we need to wait for the next candlestick. So the next candlestick is what is going to give us the signal. Either the market will continue going to the upside and creating, you know, those bullish pushes to the upside, or the market may continue pushing to the downside. We don't really know exactly, but again, we can begin to build a narrative, more especially with where the candlestick type the candlestick is formed. So if it is formed at resistance, then we can begin to anticipate, you know, a reversal and the creation of lower prices. Now, the last type of candlesticks that we can look for or we can look at are called, you know, morning and evening star. So the morning and evening star is just a combination of three types of candlesticks. Number one, it is made up of a bearish candlestick. Then we have either a doji right here or a spinning top, then a bullish candle. So this one engulfs this one right here. So this one then tells us that buyers are interested in this area now that we have a confirmation of a bullish candle. And then here, it just shows us that sellers are interested in this level because of the bearish candle. Now, these are not the only candlesticks. Like I said at the beginning, these are not the only candlesticks. There are different types of candlesticks. You'll find piercing lines, you'll find tweezer tops and tweezer bottoms, you'll find railroad tracks, you'll find white soldiers, different types of of candlesticks. All right, you find the Marubozu type of candlesticks, etc., etc. All right, but these are candlesticks that you will easily identify with, and you'll be able to at least be able to pinpoint them whenever you see them, that okay, the signal that I'm getting right here is this one, based off what you've just learned from these lessons on the candlesticks. Now let us go to the charts and let's begin to identify this type of candlesticks and see how we can take advantage of them when it comes to analyzing the charts. Hello there. In this lesson, we are going to look at how you can now identify support, identify resistance using candlestick patterns. Now, this is something that is going to blow your mind, all right? Because we have been taught, and of course, I'm going to touch on that one. I'm not refuting the fact that that is not a valid way of looking at support and resistance, all right? But you can also determine where your support is going to be formed and where your resistance is going to be formed based off candlestick patterns. And this, it doesn't matter the time frame. It could be the daily, it could be the 1 hour, 4 hours, etc., etc. All right, so the first thing that we need to understand about support and resistance, and again, I'll explain this more in details when we start looking at support and resistance and how to deal with support and resistance. So the first thing that you need to understand is when the market is pushing, then it reverses, all right? That reversal creates what we call a resistance, all right? So this turning back of the market right here, all right, right here, creates a resistance. So a resistance has been created. So resistance created. All right, so resistance created. All right, now you need to understand that for a resistance to be validated, we need another touch on that area, meaning that price should go back to this area, retest that area, and if price is resisted again, then we know we have a verified area of resistance. So if we have a second touch on an area that was created, then we have a verified area of resistance. Then, of course, once price approaches it next time and gives us a candlestick pattern, we can, of course, take a trade and we can target either this area of support that was created here or also this area of support that was created down here. All right, so that's how resistance is created in the market. Excuse me. Okay, now let's continue. So we have resistance created. At the moment the market pushes from here, all right, the moment the market pushes from here, all right, what is happening down here? We have support created. The fact that the market leaves a price level, it turns from a price level, all right, what we're going to have is a support created. So we're going to have support created. Okay, now I'm presenting this to you in a most simplified way. I don't want you to start thinking trading is difficulty. Okay, so we have resistance, then we have support. All right, so what do you think is going to happen here? There are two things that price is going to do once it approaches a previous resistance that was created. So until then, we don't know whether that resistance is going to hold or that resistance is going to break. We don't know. All right, so what we need is a confirmation around that area that the market is going to respect that resistance or break that resistance. So for as far as we are concerned, it is just a created resistance, and this one is a created support, nothing. All right, so I am not going to start planning my selling opportunities right here. So I'm not going to say naively to say I'm going to sell right here, put my stop loss above because it's a resistance and then target this support. We have no such assertion. We have no such validation. So in order for us to validate that this is a resistance, we need price to reject off of that level. So the moment then price rejects off of that level, all right, then we are going to have a validated what? Validated resistance. So we're going to say resistance validated. All right, so resistance validated. So that validates our resistance. Okay, that validates our resistance. Then as the market, sometimes the market can then decide to pull back to the same area. Now, what are we going to look out for here? We are going to look out for those candlestick patterns that we looked at. Remember the type of candlestick patterns that we looked at. So it could be we have a bullish, a bearish engulfing. So let's say price then comes and gives us a bearish engulfing pattern like this. So we have this bullish candlestick right there. Let me just make it look a little bit better. So we have right there a bullish candlestick. Then definitely we have another candlestick that goes down. Okay, so we are going to have this one to be a bearish engulfing. So now once we have a bearish engulfing around this area, okay, once we have a bearish engulfing around this area, then we know that it's a good area to look for those selling opportunities. All right, so this is a signal that we want for us then to confirm that that's a good area. Then we're going to enter a trade at the open of that candle, put our stop loss above, take profit maybe down there on that support. Because again, we don't know whether this support is going to hold or whether it's going to not hold. So what we want is also a validation of this support. For me, I would even target somewhere down here because it has not yet been validated. What we have is a validation of a resistance. So it was validated here, then we looked for the entry right there. Even at the validation, if we have proper confirmation, we can still get an entry, because what we want is some kind of pattern right there. It could be a chart pattern, a double top, all right, any chart pattern that can be, identified. But I don't want to make things difficult for you. I just want to make it simple. So look at the candlestick pattern, and if there's a chart pattern, maybe just an M pattern or a double top pattern or a head and shoulder pattern is fine. All right, so yeah, there you're going to take your entry, then you're going to put your stop loss just below, above the candlestick, above the pattern, then the stop loss the take profit just below the area, all right, where you can have your 1 to 3 if your risk to reward is 1 to 3. Now, let's say now price is coming down here, all right? Let's say price now hit your, it has activated your order, then it comes here. Then right here, we have a candlestick pattern. Let's say we have this type. Okay, so price comes and rejects off of this area. Okay. So price comes around that area, and then there's a rejection of lower prices. All right. So what's this? It's validating that support is working. All right. It's validating that support is working. All right. It's validating that support is working, that buyers are still interested in buying the market right here. So support validated. So support validated. Okay, so that is what you need to start looking for. And of course, even with the validation, you can still take your buys upon the close of the candle. Let's say if the candle closed here. But like I said from the lesson that we had on candlestick, I don't really like this type of a candlestick. But if it was a bullish one, if it was a bullish one, which means the color was green, I would definitely go for that. So most cases, this is going to happen where now the market will push even further up. Let's say there was a news event, all right? Just trying to, imagine there was a news event. So then the candle, the market is going to then push and hit your take profit like that, all right? So it may even give you a wick like this one. Maybe even the wick went down, you had some drawdown a bit, then price decides to lift off from that area and then goes to hit your take profit. Okay, so that could be a validation. So already this rejection around this area, it shows you that buyers want to buy. Okay, so we have a creation, then we have a validation. All right, now this can be illustrated using candlesticks. So I was trying to illustrate to you using just how you can look at resistance and support, etc., etc. But then let's now illustrate it using candlesticks. So let's say you are on a 4-hour time frame, or you're in a daily time frame, whatever time frame it is. So let's just assume the market is pushing to the upside and the market is creating these highs and lows. Okay, so we have these highs and lows, and again we have another candlestick that opens to push the market up. All right, and what happened? Maybe we had such kind of a thing, and then we have another candlestick open, right, trying to push the market where? Trying to push the market to the upside. And what do we have? We have the candlestick like that. Okay, so now what is going to happen here is as the market is pushing like this, okay, as the market is pushing like this, okay, then we see a red candle. All right, a red candle. So the moment we see a red candle from here, and then the red candle comes down, right? Whether the candle has broken the previous low or not, right? Whether the candle has broken the previous low or not. I want it to be at least perfect. Okay, so whether the candle has broken the previous low or not. Okay. What we have now there is a resistance, right? I believe you're getting what I'm getting at, what I'm explaining. So what we have now there is a resistance, right? We have a resistance. Let's see. Okay. Okay, so what we now have there is a resistance. Where is the resistance? The resistance is right here. Okay, so the fact that the market could not trade above the close of the previous candle, all right? And then we see a red candle coming in. So here, what we have here is sellers are resisting buyers. So here we're going to say sellers are resisting buyers. That's all. Sellers are resisting buyers. All right. So this red candle that comes in, it's sellers trying to resist buyers. All right. So what that is going to look like, or it's going to appear like, is price gets to this area, and then we move away from that area. So that is the creation of what? Creation of resistance. So that becomes your resistance. So here, creation of resistance. So resistance, let me just say resistance created. Perfect. So resistance created. So here we have resistance created, okay, just like this one. Now, having this resistance created does not in any way then mean that the market will start pushing to the downside. Okay, does not mean in any way that the market will start pushing to the downside. It just means that right there, resistance has been created. So in order for us to have a validation of this resistance as indeed a resistance, let's say the market again opens down here, all right? Let's say it pushes down further, all right? So we have a further push to the downside. Now, after we have a further push to the downside, okay, let me just move this to the right. So after we have a further push to the downside, all right, then the market decides to go up, right, a little bit. Okay, it creates a green candle. Now, when this happens, again, what do we have? We have a support created. Okay, that's how a support then is going to be created. So down here, what we have is we have a support created. Okay, what does that mean? Again, here it is buyers are resisting sellers. So buyers resisting, resisting, I think that's the resisting, anyway, resisting sellers. All right, so what happens is a support is created. All right, so here support is what? Support is created. So I can say support created. All right, so again, what does this mean? So if I may illustrate it using this example, so what we have is we had the market, all right, the market pushed, created a resistance, then came and created a support somewhere here. All right, so now price is here. All right, so price is in between. All right, price is in between the support, this resistance and this support. None of them are valid. None of them are valid yet. All right, none of them are valid yet. Or none of them is valid yet. That's the correct English. None of them is valid yet. All right, so what we need now to do is to wait for validation. All right, wait for validation. So you don't have to start taking the trades. You wait for validation. Why? Because most cases you observe that market will be hitting these areas more often, pushing up and down, etc., etc. But then you have to wait for what? For validation. So let's say the market pushes aggressively, right? So the market pushes aggressively. Then as the market pushes aggressively, right, what do we have? We have, let's say, a bearish candle. All right, so it pushes aggressively and then there is resistance. Okay. Okay, so it pushes aggressively, then there is resistance. Okay, what does that then actually mean? All right, so there we are going to have validation now. So this is now validation, right? What? Validation. Meaning that now price is still, sellers are still holding their position right there. All right, sellers are still holding their position right there. All right, they are not ready to let go of their position. So even here we have buyers, but these buyers here are not yet validated, but we have sellers that have validated their position. All right, they are holding their position. Okay, so right here, you can even plan to take your trade. Let's say you get your entry right here, you put your stop loss above, you can even target maybe something down here, because there we have not yet validated buyers. So it's possible that these buyers could be broken because sellers are coming in aggressively. And of course, in most cases, you may even see the market just open, and what happens? It rushes to the downside and gives you those. Let me just draw one candle just to avoid a lot of drawings. So let's say the market then opens and it just takes you down like that and it hits your stop loss. Okay, so what do we have here? We had an M pattern. All right, we had an M pattern. So here the market came, validated that one, then gave us a signal of entry, and then what happens? The market then pushed to the downside. Okay, so that's how the market, support and resistance is created. So in most cases, once the market does this, all right, once the market does this, remember we had a support that was created and yet it was not validated. So let me remove this. So we had a support that was created and yet it was not validated. All right, so support was created yet not validated. All right, so now when the market begins to push to the upside, so let me just I want this thing to get into you so that once we go to the chart, it is going to become very easy for me to explain. So once the market then begins to push up, right, it will push up. Let's say this is a green candle, right, and then again it will push up with a green candle. Again, it pushes up with a green candle. Now price is here, right? So what do we have? We have a pullback into the area. Now, as we have this pullback into the area, remember, we just broke through a support. So that break of a support could be a support turning into what? Into resistance. All right. So most cases, again, we don't have to take a trade simply because we are back at this area. All right. Remember, this area was not validated. So what do we need? So if it's going to become a resistance, then we need a validation of that area. All right. We need a validation. Why? Because sometimes the market can still go back. All right. The possibility of the market going back here, very high, very high. All right. Very high. So the market could still break into the support, then comes for a retest, then go. So if we have such kind where we have a retest of this area, a retest of this area, because this support was not usually used. So I'll give you two scenarios. I don't know, this is becoming longer than I expected. Okay, so I'm going to give you two scenarios. So let's say price continues to push, like it pushes after we break through the area, the market pushes, all right, then we didn't again respect the support. All right, the resistance was not respected, so we broke out, we are breaking back in. Then if the market then decides to pull back, right, the market then decides to pull back, okay, the chances that it will pull back into this support, which was never used or validated, which then became resistance, which again was never validated, and now it's going to become a support again, a very high. Okay, let me just remove this. So price comes back to this area and to retest. Once an area is validated, that's when we are going to look for those buying opportunities. So let's say the market comes here, and what happens? We have a bullish candlestick like that. All right, we have a bullish pin bar like that, based off what we learned about pin bars. So we have this pin bar like this, okay, on this area. Okay, so what then that means is that we have a validation now. This support now has been validated, meaning that now buyers are willing to hold this level. All right, so if they're willing to hold this level, where do you think the market is going to? You don't have to forget that we still have this area right here, and also the fact that we created this pullback. All right, this could become a mini resistance. So this could be considered as, let's say, a mini resistance. So you can consider this one to be a mini resistance. All right, it could be a mini resistance. All right, which you could obviously expect it to be taken out because you have this high right here, and also there was a new support which was created down here. So this then becomes your new support. All right, so you've got this level here, you've got this level here, then you've got that level right there, which is still holding, which led to the market to push to the downside. And then from here, you can even decide to take an entry. All right, you can take an entry, of course, because there now it has given you confirmation. But then you need to look at your risk to reward. How much is it before you hit your next resistance? All right, is it a good risk? Okay, if it's not, you can just leave it out. And once you do that, you can wait for price to break out of this one right here. All right, because this one seems to be holding. You can see how price held this area. Now price is approaching that area. So if price then approaches this area like this, okay, if price then approaches that level like that and breaks it, okay, price approaches that level like that and then breaks it, then you have now a signal that, okay, what are we having here? We have broken out of this area, right? We have broken out of this area. So in most cases, I don't really encourage taking breakouts, all right, because sometimes price has a tendency of pulling back in. But then we can wait. Sometimes the market will do a quick retest of the area. All right, so let's say price sometimes will do a quick retest of the area. So once the market comes back and retests this area like that, okay, then this now becomes our entry. Okay, this then becomes our confirmed entry, and we can take our entry based of this one to take a buy, put your stop loss below this pin bar, then you can target your 1 to 3, which is this one. And of course, we may expect the market to push, at least here, I'm expecting the market to do what? I'm expecting the market to push to the upside, meaning that if the market then begins to push, let's say the next candle opens, I'm anticipating this move to happen. All right, clean move, I'm anticipating it. But then, like what I'm saying, nothing is really guaranteed in this market. So the most important thing is always be working with a stop loss. Don't forget your stop loss. Don't forget your risk to reward. Okay, so that would be then my entry, and I would target 1 to 3. So I want to wait for a validation. All right, so once we break, then it becomes our support. And also internally, we may even have this area as our internal area, okay, which was not retested. So price could either retest this one here, or it can come and retest this here, which was also a support, a resistance, which was broken. So that is how the market will behave in most cases. All right, so I've explained a lot about this, so I'll see you in the next lesson. Bye-bye. Hello there. Now let us look at how you can apply what we just learned in the previous lessons to map out our correct support and resistance areas using candlestick patterns. Now, like I said, whenever you see a candlestick come down, then it goes up. It means there's a resistance or there's a support that is being created. Now, let me just begin with this area right here. So what do we see here? So we see the candle comes, this is a bearish candlestick, then a bullish candlestick goes up. Then what are we going to have right there? We are going to have a support area. All right. Now, if we can draw this all the way to the right, okay, I'm going to use, let me just make it black so that we can see clearly. Okay, so if I draw the line like this, okay, what are we having right there? Now, remember, this is a daily time frame. All right, so we are looking at everything from a daily time frame. So what are we having right there? So we have, number one, we have creation of support. So support created. All right, great. Then number two, we have, what do we have? Support validation. Support validation. Now, what this means is that the market buyers are still holding the level. So if buyers came out of this level, then price comes back to the same area. What does that mean? It means buyers are still holding the level. All right. Buyers don't want to let go of that. Now, what's the confirmation that buyers are still holding the level? You can see here we had a bearish candlestick, then we have a bullish candlestick. So this bullish candlestick and the next one, which closes above this previous candlestick, it shows that buyers are not ready to let go of that level. All right, now we have validation. Then here we can take our trade. So if price comes back to the same area, right? So take trade. So if price comes back to the same area, what do we then need to do? Then I know what to do based off the candlestick pattern that is going to be created. So if price creates this one, right, then I'll take my trade, put my stop loss below the level, right? Then I'll target my next area, all right? So which could be this one right here. Okay, because that's where we also had a resistance created. So you can see from here, we had a trade that we could have taken. Okay, now this is an example of a buy. Now let's look at a sell. So first thing that we need to see is that we have a push, then we have a pullback. Now here, what do we have? We had a push to the upside, then we had a push to the downside. So meaning that here we had this as a level. Now if I take it to the right, keep on taking it to the right. Okay, what are we going to have? We are going to have an area where there was a resistance created. So here we can call this one to be resistance created, resistance created. Then we have resistance validated here. So this is where the resistance was validated. So right here we have resistance resistance validated. Then, okay, so after validation, price comes back to the same area. I would look to take an entry here. So trade taken. Okay, trade taken. Okay, not trick, but trade taken. Okay. Wow, this is so great. This is so powerful. Now trade taken. So how do I take a trade? Price comes back here, then it gives me this candlestick pattern, right? Still showing me that sellers are still interested in this area. Then we can see a push to the downside. We have, this is more like a hanging man. Then what happens? The market begins to drop to the downside. Then I would take my sell right here. So take my sell from the opening of this candle, stop loss above, right? And where will be my take profit? So where to put your take profit is also somewhat very important. Now we can see that here we had this area right here, and a new support was created right here. It could be support was being authenticated by this rejection right here, but of course that's where we would target our trade. So trade will be targeted right there. Okay, so you can see that how beautiful it is to take a 1, 2, 3, just nice trade based off what we have already looked at. So we have number 1, support created, support resistance created, support resistance validated, then trade taken. Okay, how about this one here? It's still the same. So we had a creation, a validation, then trade taken. Based off what? Based off this bullish engulfing. All right. So as though that is not enough, let's look at this one right here. All right. So let's say we had resistance created right here. Okay. Now, when it comes to resistance, it doesn't have to be the exact place. All right. It has to be a zone. It has to be a zone. All right. So it has to be a zone. So you can see how price really behaved right here. So we had resistance created. All right. So you can say resistance created, resistance created. Okay. Then resistance validated right here. Validated. And even at validation, you can still take a trade. Resistance validated. Right, then we have resistance, can take a trade even right here. So you can say trade taken, trade taken. So trade taken. Okay, trade taken. Okay, so what will make me take the trade? So I have this candle, then we have a bearish engulfing, a bearish pin bar. So upon the market closing with that bearish pin bar, and it is black for that matter, I can take a trade right here, put the stop loss just above, and of course, where would be my target? My target will be the support which was created. Okay, so that is going to be the trades that we can take. So we can take number 1, this trade, we can take that trade right there. And what else? What other trade can we take? We can also took, a trade right here. We took a trade right here. All right, so that is very powerful, super powerful. So again, we go back to the same methodology here. We're going to have support, resistance created. Now, let's look at what is going on right here. Okay, so already I'm giving you the strategy already. We haven't even gone deeper. All right, so the rest of the lessons will just reinforce on what we have already looked at. So we have resistance created. There might be also some other areas right here, but these are not very clear because we need 2 candlesticks like this one, not where we are having a lot of gaps. All right, so we need 2 candlesticks like this one. So even here, we had a support created, a return to that support to retest, then price push to the upside. Then here we had a pullback. We had a reaction. Now, this reaction, you need to look at it carefully. All right, this reaction, it did not create a black candle, or it did not. It was not followed through by another candle. So if that was followed through, we would have had another resistance created right here to validate this one. So this would have been the validation of this resistance. However, that could not happen. So what happened? Price then broke through. So breaking through, price came back immediately for a retest. Again, price pushes. So again, you can see right here, we have another one, which is here. So this is another resistance that was created. So here it was not validated. So remember, we have resistance created. Where are my twos? Where are my twos? Where are my twos? Where are my twos? Okay. We have resistance created. Resistance created. Okay. Then no validation. So resistance broken. Broken. Now, after resistance has been broken, what should follow? We need a retest. So a retest should follow through. Okay, so price comes, retest. So immediately we had a retest and the validation together. So a retest, which is this one. So retest. So support, retest. Okay, so resistance tends to support and tested or validated. Let's say validated. Okay, validated. All right, so tends to support and it is validated. Then we would look for the entry. So entry right here. So entry. Okay, so entry right here. So this is how you would take this trade. Now, of course, you can say, oh, it looks so easy. Yeah, it's supposed to be. It's supposed to be, man. It's supposed to be. It shouldn't be complicated. It's supposed to be easy. That's the purpose. It's supposed to be easy. So again, here we break. So here, resistance was created. Now, resistance created. So now after resistance is created, what happens? There's no validation except price breaks through it. Then we come back for a retest. So here we are having a retest. Okay, so resistance to support. Okay, and retest. So support, resistance to support, and then we have a retest. Great. Then again, let's look at what is happening. Immediately, we had this bearish candle, a bullish candle. What are we having? We are having a support area right here. Okay, at the same time, we also created a resistance area right here. Okay, so this then creates a zone for us. All right, it creates a zone for us. So what that means is that price came for a quick retest, then pushed to the upside, but again came back for this area, which is a support that was created. So here could even identify quite a number of support and then just wait for price to do its thing. So if we say this is a support, then price came back for it. It was a retest of that support, right? A validation of that support, etc., etc. Quite a number of things happened. All right. So again, what do we have here? We have another one. Okay. Resistance created, resistance validated, resistance taken. All right. So here again, resistance created, and what follows? Resistance validated, then what happens? Then trade taken. All right, so trade taken. That is if you trade on a daily, but this same method can be more trade taken can also be applied on smaller time frame. All right, if you're a scalper. Okay, so again, right here we had a break of this area. You can see how we created a support. Then support was not basically respected, but then price still came back to it. All right, so already you can see how effective this thing is and how you can apply it to your own trade. Okay, so apart from that one, we also have here, because here nothing is happening. This is not a support. All right, this is not a support. Let me highlight it. So you may get confused to say, how about this one? This is not a support. So no support was created except for a resistance. So here Here's no support was created. No support was created. Right? But on top, resistance was created. So you can see right here, resistance was created. Okay. So here on top, resistance was created. At the bottom, support was not created. So resistance was created. Okay. And resistance was broken, then price came for retest. Then that is another buy. Let's continue. We have more. We can even pick this one right here, which is a little bit better. So we have this one, which was a resistance. So resistance becomes support. Okay. So resistance created. Resistance created. So resistance created right there. Then what happens? Resistance tends to support. So resistance tends to support. All right, so just follow through. Again, here we can say we have support. So this one was support created, support retested. Again, we can keep on going up and up and up and up, and we'll have quite a lot of things going on. So resistance created. Again, what happens here? We can say here support was created but never tested. Again, what happens here? Here resistance was again tested, created, and yeah, stuff like that. So you can see how you can just be looking at these things and be able to tell what the market is going to do next. You will be able to tell based off just these things, and you just following up these things, you'll be able to tell. So here we had a support created, and the moment price breaks out of the resistance, you can even buy it. All right, so here we had a resistance. Then the moment price breaks, we have a quick retest of that support. Then you can buy it. Again, you can see how here we had this perfect support and price came back to it. What happened? Yeah, that was a nice move. All right, so here resistance was created, but resistance was never retested. And you can see how it affected this move right here. All right, the market affected this move right here. Okay, so quite a number of things are happening. Let's see if we have any other. All right, so we have this support right here, and let's see how it also goes to affect the future. All right, so yeah, definitely does affect the future, because you can see how price was able to reverse from that area. Okay, so if you have this information, now tell me, what would make trading to become very tricky? So if you are looking at your areas or your levels from the highest time frame, then you'll be able to analyze effectively. Here we had support. I was created. Immediately, we had a pullback into it. Then we created another resistance, right? We created another resistance. So I'm just doing this in order to make you see the things that I see on a daily basis. Again, here we have support, support. All right. And here we had the resistance that price has not yet come back to. Okay, so all of these areas are quite important. All right, all of these areas are quite important. So sometimes you may not know or understand the reason why price is doing what it is doing, not knowing that there are areas of interest price is trying to come back to, which were not, of course, tested. And then you'd observe, okay, so that's the reason why this happened like that. Exactly. That's the reason why that happened like that. So I hope you have understood this. I'll see you in the next lesson, where we're going to look at the lower time frame version of what we have looked at on the higher time frame. Hello there. Now let us look at the lower time frame version of the higher time frame support and resistance. And of course, you may be asking to say, do I have to draw lines everywhere? No, not necessarily. You only draw lines in places that are of interest. All right, so this type of identifying support and resistance in this way, it helps you to avoid the aspect of having too many lines on the chart. All right, so you only focus on those areas which are quite significant to you. All right, and it helps you to be so focused to have your chart clean. So let's say this is what I'm looking at. All right, so if this is what I'm looking at, then I'll know which support and resistance areas to focus on. All right, I'm not going to focus on every line that has been ever printed on the charts. All right, I'm not going to focus on every line, so I'll know what to focus on. So let's say this is my resistance, we are coming back here. I'll know what to do based off the type of candlestick that I'm going to have at that particular time. All right, so even here you can see this resistance, price comes, reacts, but fails to fall through, then price tries to break above it. So now can even take it now to lower time frame. Okay, just pardon me a bit. I think these lines are not visible on the lower time frame. So let me just change that so that we can have them also on lower time frames. Okay. So if I go on the lower time frame, let's say I go to the 4 hours, I'll be able to see something. Okay, so I'll know that this level is coming from the higher time frame. That I will know for sure. It's coming from the higher time frame. And now that we are around this area, there are two things that is going to happen here. Price is rejecting from this area. Okay, now what am I going to do? I'm going to now update my drawings on smaller time frame. So this is another resistance that I have right here. I mean, this is another support that I have right there. Excuse. So I'll see support created, support retested. All right, I'm still looking for the validation. So we can even have this validation right here. And of course, we can take a trade based off this validation, putting our stop loss below here. All right, but now we don't have to take trades based off higher time frames. So if I want, I can even refine it even further and say, okay, so on 4 hours, I'm looking at this range. All right, so let's just keep this one. Let's just keep this one. Let's just keep this one. How do I do it? Let me just change the color for this one so that we know that it's coming from the higher time frame. All right, so now I'll have this range and this range right here, and then now I'll move to lower time frame. Okay, so in my lower time frame, I don't know, is my bar replay still active or it's gone? I don't know. Oh, okay, still very much active. Okay, so I'll then begin to focus on the lower time frame. Okay, so on the lower time frame, that is the M15, what am I going to start looking for? All right, I mean M30. I'll start looking for areas like this. All right, so I can keep on upgrading my zones or my levels based off what I am seeing on that particular time frame. So you can say we had resistance created. We keep on playing around this this support, rather not resistance, but we keep on playing around this support. Okay, and then also what happens, we also have some kind of resistance which was broken, then became support, etc., etc. Then price breaks back through in. So if I was to take a trade, all right, let me just show you what I would do. Okay, so if I was to take a trade, then I see this happens. So we had also support, resistance, which became support, and then we have broken through into it. All right, so I'll then go to my M5 time frame and I'll look at what is really going on here. So we've broken this area. So if price then were to pull back into this area, okay, all right, did I have a proper pullback? Yeah, I had, except that price has already moved. So let's say price comes back to this area. Okay, this is where now we need to start looking for better entry options. Okay, so if we can't find any better entry options, we can even go up to the higher time frame and see. Okay, so we don't. How about going back to the M1? Okay, so this is just you trying to find a better entry, knowing that price, of course, may retest this area. So after we are having a pullback to that area, we can look for some kind of bearishness coming into the market. So if we find this bearishness, coming into the market. Our stop loss can just be above there. Our take profit will be on this support right there. All right, so this is going to be our support, though it's not a good risk to reward, but yeah, it does really work very well, and the market goes to hit our take profit. So of course it will look so cumbersome on the lower time frame, but then if you go on the higher time frame, you know where the market is coming from. You know exactly where the market is coming from. All right, you know exactly where the market is coming from. So yep, that's that. So now let's go back to the higher time frame, okay, which is 30 minutes. So 30 minutes, we have this area of interest right here, and we know that this is around this orange line, and we are expecting price to push to the upside because this is a retest of that area. So what we now want is to refine that area in our lower time frame. Okay, so price comes back to that area. Do we have any signal that we may be pushing to the upside? So you can see how price is rejecting this area, but then what you need to see is a candlestick that will take you away from this area. Okay, so now that we have this candlestick that takes us away from this area, I'm going to take a trade, and a stop loss is a little bit going to be bigger, but then where will be my take profit? I'll be targeting this high right there. Okay, so although it's not a good one, but based off what we have looked at, okay, and this is where if you're taking this as a long-term trade, then you will even go back to the H4 and then begin to see things clearly on the H4 of how price then is going to begin to unfold. So you can see how now price pushes all the way to the upside and it hits your take profit. So you took a trade based off the lower time frame, having the higher time frame idea or having the higher time frame analysis. And if you are going to target the 1 to 3, it's going to be something like that. So here we are, we took this trade based off the lower time frame entries, or you can even still take another confirmation the moment price broke above. Now let's look at this. So the moment price broke above, so you can even say yeah, you can just leave it like that. So the moment price broke above this area, then we came around this area to do some kind of retesting, and then what happened? The market then just pushed all the way to the upside. Okay, or we could even have taken it from here. Okay, if we waited patiently, we could even have taken it from here with a good risk to reward, and that's how the market would have just paid us. All right, so if our entry was right here, it could even be 1 to 8. Okay, so that's how you look at the market. Now let me just delete everything and let's go back to the market. Let's start again. All right, so again, let's say we are where, let me cut the chart. Let me just cut the chart somewhere here. Okay, and let's look at what we can do with this information that we get here. All right, so what we have now is I have a support around this area right here. Okay, let me just make it a little bit, orange to know that it's coming from somewhere. Then we have a resistance that price is coming back to. So we had this resistance. We are trying to validate the resistance right there. Okay, so let's see. Price then rejects that area. Okay, now after price rejects that area, all right, it's a validation of the resistance. Okay, we are validating the resistance. We have a bearish engulfing pattern. Then we can go to the downside. We can go all the way to the lower time frame and still look at other things that we might try to put into place in order for us to see if we can maximize on that trade. So the first thing that we can see is that we still have this support right here that was created by the market. Okay, so I want to change the color. Okay, let me make it teal. So we have this with a diamond green color. All right, so we have this support that was created by the market. At the same time, we also broke through, let's say we also broke through this area right here. All right, so this is also a support that was quite visible. All right, and then we broke through it. Then after we broke through, all right, do we have any pullback? No, price just falls. The price just falls. All right, so in this instance, I don't really like trading the, the breakout, the breakout, but I would love to trade the pullbacks. If price were to pull back into that area, then that would be my trade. All right, yeah, but then, okay, yeah, exactly. No, not this one. Already here, price would have already pushed to the downside. Okay, so let's say, anyway, let's say you just take a breakout. I don't trust breakouts, but yeah, for the sake of learning, let's say you take a breakout based off the breakout strategy. And let's see if we are going to have some good risk to reward. Nope, it's not even giving us some good risk to reward. Okay, so let's say that trade worked out, and yeah, after it worked out, you can go back to the H4, right? So let me just delete this one. It's not so much important now. So on the H4, we have also a break and retest right here. We have a break. Now we had this resistance, which was not tested. All right, so the market created this resistance, then pushed, never came back to it. Okay, so now price is giving us a doji. All right, so once the market gives us a doji, it closes off with a doji. We can even go to lower time frame, like maybe the M30, and then we look at what is going on. So M30, we had this area right here, which was quite significant. Okay, so we can see price pushed, then it was a doji type of a candle, which was a support. Then we broke it, then we broke back in. Then after we did that, all right, of course, there'll be inner areas of interest like this one right here. Okay, so here, what we can do is to wait for a pullback. All right, so right here, okay, even right there, we can take a trade since we didn't have a correct pullback of this area. Unless if we go to lower time frame like M5, yeah, M5, M15, we had a pullback into that area. Okay, so let's just adjust this a little bit. It's going to be here, and we had a pullback into that area. And of course, the candlestick of confirmation is still going to be this one. So there isn't much of a difference after all. Then we put our stop loss below, or just 20 pips down, 20 points down. Then where will be our target? We can target this area, right? That would be our first target. Okay, so let's see how market moves, plays around. I think this should be morning hours, pre-market, then price. Ooh, it hits my stop loss. Wow. Okay, you're right. It hits my stop loss. Okay, so that is bound to happen in trading. Yeah, that is bound to happen in trading. I don't have to be surprised. That is bound to happen in trading. So now let's go back to 30 minutes and let's see what the market did actually. So actually, it gave me a signal right here that what is going to happen is price is beginning to push the downside. It gave me that signal, and we also had the bearish engulfing right here. All right, so what we then wait for is for price to still come back to this area, right? And also come back to confirm this area again once more. All right, so let's now look at what is going to happen right there. Okay, so price, then I want to see bullishness coming into the market, right? I want to see bullishness coming into the market right there. So now we have a pin bar. Okay, so we took that loss, but then price came back to retest this support, which was created. So we created a support here, then price came to retest it. All right, then again we validated it, then here is where we find our entry. So our stop loss then is going to be above here. Okay, so stop loss down here, then targeting that area. Why am I targeting that area? Because it has not yet been retested. Okay, even this area is still a resistance, so meaning that my first target would be here, then my second target will be there, then my third target will be here. All right, so let's see how it goes. the market begins to push. We first hit our first target, we retest the area, then price begins to push, we hit our second target. Let's see if we're going to retest the second target. Did we retest it? Not necessarily, but then, yeah, we come back for a retest, then price pushes to the upside. Okay, so, and we hit our third target. So we hit our third target. That's about a 1 to 5. Now, knowing where the market is going back to, can even go to the higher time frame, which is the H4 from where we got the signal. Then what happens? We have this resistance that was created, and boom, the market smashes the TP so heavily. Okay, so this is one of those kind of setups and trades that you can obviously look to take. Okay, so now again, let's continue. Let's look at more examples. So remember, my purpose of showing you this is just to show you that these things work in every time frame that you look at. Okay, so let's continue in the next lesson. Hello there. Okay, let's look at the same concept now in the lower time frame. Now, remember what I said, these things apply whatever time frame that you are looking at them. The most important thing is to understand what you are looking for. Okay, so now let's look at, again, here we have a resistance, and look at how price came to that resistance. So we created the resistance, validated it, price came back here, it gave us, you know, those entries. Obviously, you might have been taken out by this week, but then if you waited patiently for this week to close and then take your trade, where would be your take profit? Of course, this support right here. Okay, so this support will become your take profit. Okay, so you can see how the market from here rejected this area. Then after the market rejected that area, you would take your entry based off that, like this. Okay, your top loss just above, that's quite big, and your take profit just below here. All right, so it's gonna give you a very nice risk to reward. And also knowing that after we have this closure of a candle, you can even reduce your stop loss, because I believe price may not necessarily pull back to that area. Okay, unless if it wants to do a weak fill, that's when it can do that. But in most cases, it might not pull back to that area, and then you can target this low for your take profit. And then what happens? Price breaks the area. We have another, you know, support, resistance created here. Then price gives us a bearish engulfing, and then this is the open. So what happens? We have also a form of resistance that was being created right here. Then price comes back to it, right? Although it's not a good one, but price comes back to it, and then we see a push to the downside. So again, what are we having? We are having this area right here, and also we are having this area right here. Okay, so these are our major, you know, support and resistance areas. And of course, we have already broken to the downside. We are here. So what I just want to see is, are we going to create a support? So quite all right, we create a support in this area. So this then becomes our support area. Okay, so now that we create support is not still valid until we break above it, until we come and retest it. And also here, resistance is not yet powerful until we retest it. So let us see how price reacts. So we react off of that level. We are coming down again, and we are still looking for proper setup. So here internally, we begin to see price creating this kind of structures. But then what would be your major areas of interest? Look at that one, look at this one, and also look at that one. So these are your areas of interest. And again, in the next lesson, I'll explain more on that one. So we are just trying to look at how support and resistance is created using just candlestick patterns. So already the market is trying to retest this area. So you can see we had a retest, although we created another support right here, but it is just around that area. So if you're working with a zone, it is around that area. And of course, you would look for entries you'd look for entries. How would you look for entries? Okay, because if I were to look at this area, I would consider this as a zone, right? I'll consider this as a zone. So all this area would be a zone for me. Okay, so and how do I then look for entries based off this zone? Okay, I would then look for a bullish engulfing pattern right there. Although this trade was not an easy trade to take because a lot was going on, and then just put my stop loss below, and my target profit will be, of course, this resistance right there. Okay, that will be my target profit because I know we have not yet tested that resistance. And of course, price fails to hit it, it's okay. Sometimes that is going to happen. All right, but then I would have already secured how much? Maybe if my average is 3R, then I would have already secured my 3R. Okay, and I would have already been out of this trade. Okay, then price comes, all right, hits that area. Okay, so what happens? We have another range. Okay, so I'm still waiting to see what the market does. So we break below and come for retest, and the market again, look at what is happening here. So sometimes it will become so confusing not to know what is going on. But then if you keep your range from that high and this low, everything that is happening here could just be the noise. All right, so let's wait and see again what the market is going to do. So here, one thing has happened for sure. We have broken above it. All right, now that we have broken above it, what are we going to expect the market to do? Okay, so I can clear my drawings, all these drawings. I can clear them, all right, and observe what the market has just done. So, okay, so I'm going to have this one, which is my overall. Then I'm going to have this one right there. Then I'm also going to have maybe this one right there. Okay, so these are my major areas of interest. And of course, internally, I also look at this one right here, because now these are my internal structures, right? Internal structures. Okay, so let's see what the market does then. So we break, we retest that one, and I'm just looking for what the market is going to do. Okay, so we reverse from that one, and let's see, price then drops. Okay, so again, you can see how this one is still holding. It's still holding the level, right? This area is still holding the level. Price now retests that one as our resistance. And let's see, we go back to it. And are we having any kind of proper retest? Yep. So now we have a bearish engulfing, right? Which could be our entry signal. Let's see. Okay. If we are going to push the downside, yeah, the market then drops. So you can see how that, you know, here we had this area resistance. We confirmed the resistance, then price came back to it, gave us a bearish signal, right? Of which we can even look at it on the lower time frame and see we are going to have this mini area here, right? This mini area here. Okay, this mini area here, and then from that mini area, once we have this bearish candlestick, then we can take an entry at the close of that, put our stop loss just above it, and target, our first target will be this area right here. Okay, because that's where we'll be targeting first. And if it proves to be very volatile, because of course this could still interrupt, because it's quite an important area. You can see how price kept on coming back to retesting that area over and over and over and over. So it could potentially, quite all right, affect price behavior, just like we have seen. So the moment we break out, now we are leaving this area, obviously. Let's see. Yeah, we might be leaving this area, obviously. And let's see how the market is going to work. So we come back for a retest. So for a retest, of course, we can even say I'm going to take a trade based off that area, put my stop loss below, and let's see if price continues to go up. If it doesn't come back for our stop loss, we don't know. Okay, so I don't know what time is this, but then yeah, it comes back for our stop loss. Why is it coming back for our stop loss? Again, this is where we have to be very patient. Okay, so let's look at this again. So again, we had this area, then price came for retest. And you would see that most cases, there will be a lot of these things that will be created in the market. And you can just be approaching it and following it. And also don't forget your higher time frame areas. So like we had this area right here, which also price came back for. And then from there, it was authenticated, price came back for it. Then what is happening? The market may now be dropping to the downside. Yeah, definitely. And from there, now we have a push to the upside. All right, so in most cases, if you are following how to draw these areas, all right, you realize that it will create a whole lot of, peace and comfort for you. So again, here, you can say we had this area, right, where price came back to, or yeah, we can say we had that area where price came back to, and then we had those pushes to the upside. Okay, so the goal is just to identify your support and your resistance based off candlestick patterns or based off candlestick structure. All right, what the candlesticks are telling you. So let's see. So here, what happens? We have this resistance. So now this resistance, where is it coming from? Do we have any such kind of thing on our left side? Yeah, we have here. This was the area. Okay, so we can even begin to push this one to the right. So nearly around that area, we are having a resistance. Okay, so where do you think will be your next support area? Okay, so next support area could be, which one? Could be this one here. It could be this one here. Now this is where you look at the micro structure. So the next support area could be this one right here. Okay, so let's see, yeah, what price is doing right there. And down price, obviously price pushed to the upside. You can see how the market came back to this area, then price pushed to the upside. So just by looking at this, you'll be able to know where at least the next support area is going to be created in the market. All right, it's going to be created in the market, and you can continue, using this methodology to be able to, find those areas where the market might pull back to, might respect. Like here we had this area right here. It looked so useless, but look at what happens. Look at what happens. So price came, break to this area, retested it, and then there was a trade. Okay, so there will be such kind of things happening. So what I want you to do is just go through this with an open mind. All right, just go through it with an open mind. Try to find out these areas, how to identify these support and resistance areas. Don't think of taking any trade like I did. All right, so these trades, I was just taking them to show you, to say, based off this knowledge, you can take a trade. But I just want you to take, to just map out these areas and then see how you can, be able to use them, just to familiarize yourself and just see how price comes back to them, how price reacts from them, etc., etc. That is going to really help you a lot in knowing how to draw your support and your resistance, and also how to validate your support and your resistance. Okay, I'll see you in the next lesson. Hello there. We are going to look at the market structure. So now let me just write it, the market structure. Okay, so that is what we are going to look at in this lesson. Now, the previous one, we were looking at how you can identify your support and your resistance. Now, having that information is not enough just to get into the market and start trading. Of course, it is going to help you. You will know the right support and the right resistance to focus on, unlike the conventional way of looking at support and resistance, where you have to look at, you put multiple lines on your chart. You don't even know which one is going to hold and which one is going to be broken. That can make your chart look so cumbersome. It can make your chart look so dirty. All right. Now, without a good and a proper understanding of the market structure, you will still find it very difficult to know what the market is doing. All right. So the market structure gives us the overall idea or perspective of what the market is doing. So Nasdaq is a trending market. So it is therefore important that you learn how to use the market structure and how to read the market structure correctly. Now, there are three aspects of the market structure. All right. We have an uptrend, we have a downtrend, and we have a ranging market. And the market structure is made up of two moves. All right. So market structure is made up of two moves. And what are these moves? So the market structure has what we call impulsive move, impulsive move, and also what we call a correction or pullback. Correction stroke pullback. Right. So these are the two moves that the market has: impulsive move, and we also have the correction or the pullback. So this is what is going to make up the market structure. And also we say that the market structure exists in three phases. So the market structure exists in three different trends. So we have number one, we have uptrend market, which is made up of higher highs and higher lows. So we're going to made up of HH and H low, which is higher highs and higher lows. And also we have number two, downtrend market. This downtrend market is made up of lower lows and okay, so you can say lower lows and lower highs. All right, so this is what a downtrend market is. And the last one is a consolidating market. So consolidating market. Now, this consolidating market is made up of equal lows. So EQ, can just say EQL and EQH. So equal lows and equal highs. All right. So let me just give you an example of these three types of market conditions. So we have a higher high, higher low, higher high, higher low, higher high. So this one is an uptrend market. So in an uptrend market, we have the low, then we have the high, like that. So this one is the high. Then we have the higher low. Then we have the higher high. Then we have the higher low. Okay, let me just say higher high and higher high. Then we have the higher low and the higher low. So this one is an uptrend market. All right, so an uptrend market is a market that keeps on pushing to the upside. So it will be breaking structure. So it breaks this high, all right, in order to create a new high. Again, it breaks this high. In order to create a new high, again, it breaks that high in order to create a new high. However, it will be respecting lows. So it respects the low, right? Let me just change it into a red. So it will respect the low. So it will respect the low. Again, here, it comes and fails to break below the previous low. There again, it comes and fails to break below the previous low. Again, here, it comes and fails to break below the previous low. All right, so that is an uptrend. All right, that is an uptrend, creating higher highs and higher lows and higher highs and higher lows. However, once the market breaks the previous higher low, which it was supposed to respect, and goes up and create a lower high, again comes down, create a lower low, lower high, and lower low and lower high. What are we having now? We have a downtrend. So we're going to have a lower low right here. Okay, so we're going to have a lower low, then we're going to have a lower high. All right, so then we're going to have lower highs, and also we're going to have lower low, and of course lower low. All right, so this is how the downtrend is going to look like. All right, so the moment price breaks below the previous higher low, remember here the higher lows were being respected. So if we can draw a trend line, we can even find that we have a perfect trend line like that, although it cannot be perfect, but we had something like that, meaning that the market was pushing to the upside and it was respecting highs and lows. And you can even draw a channel if you want, and you see that that will help you to know that the market was in an uptrend because we were in a rising channel. All right, so this is how an uptrend is going to look like. All right, and sometimes the reason why people use trend lines is just to help them discover or know the trend of the market, but sometimes it's not necessary. You can't use the trend line just to help you discover or help you to know where the trend of the market is. All right, now that's awesome. So after we break below the previous low, all right, the previous higher low, the market then pushes and fails to take out that high. So this high becomes cemented. This low now is going to be targeted. All right, so what do we now begin to see? We begin to see lower lows and lower highs, lower lows, lower highs, lower lows, lower highs. And again, the market will be breaking the lows. So the market will be breaking the lows like that. Market will be breaking the lows like that. The market will be breaking the lows like that. Then at the same time, the market will be respecting the highs. All right, so this high will not be broken, so the market will respect it. All right, again, the market will fail to break this high. Again, the market, come on. Again, the market will fail to break this high. Again, the market will fail to break this high. So we can see that the market is respecting the highs as it is pushing down to create the lows. Then after that, if the market gets into a consolidation, we'll see two highs and two lows fail to break. So price goes up there, then it comes down here and respect these highs, all right, and lows. So once the market fails to take out this low, right, which it was supposed to initially take out, and also fails to take out that high, which it was initially destined to take out. So if it fails to take out this high, then it also fails to take out this low. Then what are we having now? We are having a, remember when we were looking at support and resistance, then we are having a verified resistance and also a verified support, which means that at this present time now, you can take a trade from here to there, and then after you have a confirmation, you can take a sell to here. All right, so this is what is going to create a consolidating market or a ranging market. And in other ways, we are going to have equal highs. So equal highs right there. And you know, the market will be creating equal highs. And down here, it will start creating what we call equal lows. So we're going to have equal lows down here, right? We're going to have equal lows, and also, yeah, here, equal lows, and also there, equal lows. All right, so that is the three types of trends in which the market exists. So we have an uptrend, then we have a downtrend, then we have a ranging market. Now, having this information alone is not enough, because what we are going to observe is that when you go to the real chart, you are not going to find this information as perfect as it is. All right, so what you're going to encounter in the market is something quite different. And let me just explain it so that we see how we can target our structure. So remember, when the market pushes, then comes down, here, what do we have? Initially, we have a resistance. Okay, we have a resistance right there. So let me just make it black. Okay, we have resistance right there. And once the market then goes to break it, we have what? we have resistance, which has now become a support. All right, so we also going to have another support right here, which is not created. However, when the market is in an uptrend, we expect the resistance to be failing while the support to be holding. All right, so what would that mean? So the market can either come to this area and push to the upside like this. All right, so the market can either come to this area and push, or it can come anywhere inside this range and still push to the upside. All right, so what will happen again? The market will still create a new resistance area like this, and it will also create a new support area like that. Okay, so that's how the market is going to behave. All right, so to create such kind of things. So now if you start drawing, you may realize that you're going to have so many lines and you may not even know which one is going to hold. Is it this one, or is it this one, or is it this one, or will price come to this one? So it may become a little bit tricky to know which one is going to hold. Sometimes price can come back to this one and then it goes up like that. All right, so there will be so many lines that are going to be drawn. But one thing that you need to understand is that resistance will keep on being broken, but support, we expect support to always be respected. All right, we expect support to always be respected if the market is in an uptrend. Same applies when the market is in a downtrend. All right, so when the market is in a downtrend, already we have established that the moment the market makes a U-turn, all right, that becomes our support. Okay, so this support, for it to be a verified support or a validated support, we need 2 or 3 touches on it. All right, so if the market is trending, most of the time you will see support will fail, but then this support could be used as a resistance for price to come and retest. All right, so areas that you're going to have these 3 areas, these 2 areas. So you're going to have this resistance, then support which has been broken through, which could potentially also act as a resistance to sponsor the move to the downside. All right, which is very much possible. Price can still come back to this area and then it can sponsor the move to the downside, or the market can pull back to any area inside. All right, it can even go back to this origin of the move. All right, that is 100% pullback. So anywhere in between, all right, this low right here and that high, price will still be price will still can choose any of those areas as a resistance. All right, so then we're going to have this. So immediately once you have this kind, you're going to have 3 major areas of interest, or 3 major levels. So you're going to have this support, you're going to have this resistance, which has been, this resistance, this support which has been broken, and also this support which has now been created afresh. All right, so in most cases, once the market comes, all right, we expect either this one to go. All right, so we know that this one is also going to go just like this one went. All right, so sometimes this may happen and then you may be wondering, but price never respected any. Yeah, that can also still happen, but then that does not also refute the fact that price can still come here and go up. All right, so it can still come here, retest this this support which became resistance here, and the market could still go up. But then again, what we're going to have, we are going to have again new areas. So we're going to have this area right here, and of course the same area will be extended and all that. So this can sometimes make your chart very cumbersome and tedious, hideous, not really attractive. So what you just need to do is focus on 3 major levels and wait to see what the market is going to do. All right, so what are the 3 major levels that we're going to have in the market if the price does this? Okay, and then now it is pulling back. All right, you're going to have number 1, this one right here. Number 2, you're going to have this one right here. And of course, number 3, you're going to have this one right here. Okay, so these are the areas that you are going to have, all right, on your chart. Okay, now this already tells you to say the market is buying. So meaning that as price is pulling back, what you'll be looking for are buying opportunities. All right, you'll be looking for buying opportunities. Sometimes you can take a sale, yeah, but I'd rather be looking for buying opportunities. Since we broke to the upside, meaning that we created a higher low and a higher high. So the next thing is a pullback so that we can start looking for those buying opportunities. Now, here is where things become interesting. You are not just going to have a clean chart like this. What you're going to observe also is that inside there will be a movement like this, which will also be created. All right. So in most cases, these structures that you're going to find, they'll also be posing some kind of, interesting levels. So you can have, let me just make them blue and then reduce on the font. Let's just give them 2. So you may have such areas like these ones, and sometimes it may become even complex to start looking at which one is going to hold. Will price come back to this one? Will price do this? Will this one hold? So you find that in as much as I'm discouraging you having so many lines on your chart, you may find yourself having too many lines by virtue of not knowing exactly where the market is going to come. Okay, to come to or come back to. All right. So how do we handle this? These are called internal structures. All right. This is internal structure, which is found in this overall structure. So the easiest way to avoid this type of a confusion is sometimes you can use a Fibonacci. You put it from here all the way to that high right there. And then you can just take it back to the original Fib retracement, which is just the normal. Do I have even the normal Fib retracement right here? Okay. Oh, the Fibonacci. Let me just say Fibonacci. Okay, so you can take it to the Fibonacci. And then right here, you can start planning your trade around these numbers. This number here and that number right there. At least these are good numbers that you can start planning your trade. So if these numbers, align with any of the level, then you can consider that level to at least, be potentially valid based off the fact that it is also found below a 50%, which could be a good area for your buys. All right, meaning that is going to help you to keep your chart very clean, all right, to avoid a lot of confusion. Okay, so such kind of things are going to be avoided. So remember, when you look at your chart, all right, these become your major structural levels, all right? So these become your key levels. So your key level is going to be here. It's going to be here. So this is going to be your key level, all right? Let me just give it a different color, black. So it's going to be your key level. And also this one is going to be your key level like that. And also where the pullback has started is going to be your key level. So you're going to have these 3 as your key level, and everything between this low here and that high right there becomes your internal structure. So you can even give them different colors. So when price begins to push, so you obviously begin to notice that there will be this kind of support being created, the market creating this kind of resistance, all right, where sometimes the market confuses you to say what is really going on. Am I supposed to be buying? Am I supposed to be selling? What you need to do is, if you are between the major key levels, right? If you're between this high and that low and that high, this low and that high, then know that everything here is a pullback. And you can even take your Fibonacci and put it like this, just to help you know where you are in the market. And if you see the market come down to this number, it doesn't have to be exactly here. It can just be between 0.618 and 0.786. It can be in between. But the moment you observe that there was also an inside, a zone right there, which was created, and price never came back for a retest. Okay, sometimes price may use that area for a retest. All right, so price may still come back here, and from right there you may still see some trading opportunities that you can take. Of course, this is a support that was never tested, but it is a minor support. All right, so the major ones is this one, that one right there, and that one right there. But it's not always that the market is still going to respect this one. No, it may break this one, and it may come for any minor level inside your range. Okay, so I believe this has brought home the point. Let us now get to the chart and look at how this can be applied with the knowledge of our support and resistance areas. Then we're going to use two different time frames. We're going to use the higher time frame, which is the 4-hour time frame. Then we're going to go straight to our lower time frame, which is the 30 minutes. In fact, we are going to use 3 time frames. We're going to use the daily, the 4 hours, and the 30 minutes in order to establish what we have just looked at and what we have just discussed. I'll see you in the next lesson. Hello there. Now, let us look at what we just discussed in our previous lesson, and let's see how that information can be applied in the market. Now, just coming from, you can see from far from the past, we can begin to see how market structure was being created. So how do we identify market structure in this situation? I'm just going to get my drawing tool right here. Then I want this to be on auto. So we created a low, all right? We created a low, then we had a higher high, then a higher low, then a higher high, then we had a higher low, a higher high right there, then we had a higher low, all right? So already you are able to see how we are having our structure. And now did I pick this to be my structure? First and foremost, you need to understand that when you're looking at structure, okay, again, let me repeat. When you're looking at structure, we look at, this was the low, then the lower high, right? Let me just give it a different color, red, then the lower low. Then we had that as the higher high, right? We can give it a different color of green. Then we have this as the lower low, right? We can give it a different color, red. Then we have that as the lower high, then this as the lower low, all right? So from there, we have the higher high, higher low, higher high, higher low, higher high, higher low. Okay, and yeah, on the higher time frame, it looks to be a little bit tricky and it looks to be a little bit different, but then let's follow it. Higher high, then we have a higher, okay, so higher high. Then we can also say, oh, this is one move. We have the higher high, higher low, then we have the higher high. So now we can say comfortably that the market is in an uptrend. Okay, so the structure is never perfect. So forget about looking for a perfect structure. Structure will never be perfect for these markets. Okay, so once we identify, then what do we have? We then have a break below. Okay, so we broke below the higher low. All right, so now that we have broken below the higher low, all right, we have created a lower low. Okay, what do I expect to see? I expect to see the market pull back, right? Quite. That's powerful. Now, apart from that one, okay, so I know that I am bearish. So what would be my areas of interest? Okay, so my major level will be this one right here. Okay, now if you've observed, I'm just picking the closing prices for a reason, right? Because this is where we're going to have a support, and also this one right here. Okay, so these are my two major levels. So we've got that one, then the other one, it could be this one, but then we never had a much space, enough space, all right? So it could be this one. So, but the only challenge is that we never had enough space, right, between this one and this one right here. All right, but then we can see how price came back to this area, we tested it, and then began to push to the upside. Okay, now, apart from that, we can see that inside, internally, all right, internally, we can also identify some other areas of interest internally. So we can have this one. Now let's just change the color. All right, we have that high, low high. Then say this one is a lower low, then we have lower high, then we have lower low right here, then we have lower high, then we have lower low down here, then we have higher high, then we have higher low, and price is pushing now. All right, so this is part of internal structure. All right, and how is it going to be so visible? Once we take it to a lower time frame, which is the H4, then we can see what I was drawing to be very much clear. All right, so inside here, you will also be confronted with quite a number of these internal structures. But then let's take it back to the higher time frame. All right, so right here we can just use this as, yeah, as the high. Okay, so perfect. Okay, so now what are we going to see in this type of a situation? Okay, if we go to the lower time frame, all right, we are going to have quite a number of things going on. All right, so the first thing that we're going to have is, you can obviously be able to see that we are going to have this as your what? As your resistance. All right. Pardon me. Let's take it back to a daily. There's one thing that I've forgotten. Okay, so on a daily time frame, all right, what you're going to do is you are going to take your Fibonacci, all right, just from the higher time frame. So the Fibonacci should only be used from the higher time frame, your time of analysis. That's where you get your Fibonacci. All right, so from there, after we have this Fibo, all right, then we can now go to the lower time frame, like maybe let's say the H4. Okay, so on the H4, you notice that the Fibonacci will still be visible on that time frame. Then the next thing that you need to do is, you know that, okay, we are above, all right, and as we are above, do we have any area where we can see that we are having some areas of interest where the market could potentially come back to? All right, so yeah, of course, we could have such areas. Where is it? We can say we have this area right here. This was a support, and we can give it a different color. All right, so this one, we can give it a different color just so that we are not confused with what we are looking at. Okay, so we're going to give it a blue. Okay, so now let me delete this one. So price is pulling back to that area. And then also we can say we also broke below it. All right, so that was a support. Then we had some kind of, not necessarily, we had a pullback, then we broke to the downside. All right, so now that becomes our, our area where price could potentially pull back to. Okay, apart from that one, let me just do this. So apart from that one, we have quite a number of things going on. All right, so we can see that essentially we also had this area where we had quite a number of things going on. We could have even taken a trade based off that one, come back, take a trade, and also we had a resistance right there. And then also, apart from that one, we can say that we had potentially a number of things going on. So we also had this resistance that was not used up. Okay, we also had a number of resistance. We also had this one right here. You can see it wasn't used up. And then we also had, this support. Okay, which of course, if you zoom out, all right, you could even take it up from here, all right, where we had also the support broken, nothing much happened until we came back to it. Then we gave an entry, powerful entry right here. Then look at what the market did. It pushed to the downside. Okay, so same applies to here, right? So we had a touch, a second touch, and of course the market pushed to the downside. Okay, so quite a number of things are going on in this move right here. But what I want you to see is that price is coming back to this area. All right, so as price comes back to this area on a daily time frame, all right, on a daily time frame, so price comes back to this area. So what do we expect this area to give us? Okay, so what I expect this area to give us, so let me just say, let's just ignore all these lines that I drew, and let's just say we were waiting for the market to pull back to that area. All right, so price must pull back to that area so that we can look for some trading opportunities. All right, so let's wait for the market. So the market has now put back to this area. Okay, so this area can still align itself with this one right here, which was we bought, then price decided to sell to the downside. Then again, we bought, and then a lot of activities happened, but still this area seemed to prove to be an effective area. Okay, so price comes back to that area. Then what do? We see that the market is now closing with a bearish candlestick, meaning that right here we have a new support, a new resistance area. So from daily, we can go to the 4 hours. We look at that area. We can even adjust the line so that it just fits perfectly. So there we go. So we have this area right here, and then also we are coming back to this support. Okay, so this now gives us a good area, or rather a good range to work with. Okay, and then I would then go to much lower time frame, which is a 30 minutes time frame. So 30 minutes time frame, we can see how well this support area is holding. So meaning that the moment we break down, then we are going to be in a selling opportunity. So at the moment, price is stuck right here. So again, you can see that here, this was a support area, a very powerful one, because it was once a resistance, then it became a support, then they broke it. So now price is coming back to it. But then we have not yet gotten our confirmation. All right, we have not yet gotten our confirmation. So what we need is, I know on the higher time frame I'm bearish. All right, on the lower time frame I'm also bearish. How do I say I'm bearish? We came here, retested this area, pushed, created the higher low. So higher, so we can say higher low, higher high, higher low, higher high, higher low, higher high. Then we have created a lower low. All right, so now what I want is to have a confirmation. So I'm still waiting for the candlestick that is going to give me a confirmation. All right, so now here it seems that price now is beginning to push to the upside. So I'll still wait, because now I want to sell the market. I'm not just going to rush and start selling the market, say, hey, we need to start selling. Okay, so if I'm sell biased, this is how sometimes it will be very difficult for me to take a trade. Okay, so why? Because I am sell biased. Okay, so what I'm trying to wait for is a proper signal. So let's say this one does not work properly. All right, so it is invalidated. We are no longer looking at it anymore. Okay, so now we go back up, and as we go back up, there's another internal area of interest that I would want to see price obviously pull back to. So that is another area of interest. So let us see what the market is going to do now. Okay, so around this area, all right, around this area, I begin to observe something. Okay, because again, don't have to forget that we had this area right here. So we have a zone. Okay, we have a zone that now has been created. So what I want to see is price giving me a nice selling signal. Okay, do I have it? Yeah, I have it right here. So now what we have is we have a bearish engulfing candle. Now, a bearish engulfing candle is a signal for us to do what? To sell the market. All right. So let us now enter a trade. So you can either enter based off this candlestick closure, put the stop loss above, then target, the first target profit will be this area right here, which of course is going to give me a 1 to 3. Now let's see what the market is going to do next. So price begins to drop, right? Now I have in mind a higher time frame target. So where is my target going to be? This is my first target. My second target will be this one here, right? So my second target will be this one right here. Okay, and where will be my third target? Of course, this area. Okay, so let's see how the market then is going to play out. If it's not going to take us out with a whipsaw. Okay, so price begins to push again to the upside. I don't know what is going on. So we take our stop loss hit. All right, so meaning that if I was looking for the first take profit, I would have taken out, or I would have partialed out on this area. Remember, our first take profit was here. So I would have partialed out, and maybe the remaining position would have, being closed at break even, obvious. So price comes, retest this area. This is why sometimes it's quite important to wait for candlestick confirmation. All right, so look at this. We had a break, then price pushed to the upside, started pushing to the upside, then came back to this area. Then we had this candlestick, this huge candlestick, right? Even though price tried to come back, they could not close below that huge candlestick, which then entails that price wants to even go a little bit further up. All right. Okay. So that will be my first take profit. Okay. So let us see again what the market is going to do. So again, we come back to this area. Remember, we have to validate. Then again, third touch on the same area. What is the signal? All right. What is the message? The message is we can still take the trade. Right. We can still take the trade. So let us see how the market then begins to push. And yeah, there we go. So the market still came back to the same area right there. All right. Still tested this area more than twice. So we had resistance created. Then we had resistance validated. Then we had, again, confirmation right there. So like I said, you can still take a trade on a validation, or if you're clear about price coming back to the level, you can still take another entry. Okay, so now let's say if we took this one and take it to the higher time frame, which is a daily, and then we say, what are we targeting? I'm targeting this low right here. That will be a very huge risk to reward trade. Okay, so let's see how the market dropped. Then price still came back to that area and a couple of times until we hit our take profit. Now, you wouldn't be in a trade that is going to behave like this. Of course not. All right. No one would be in the trade that would behave like this. But then if you're looking at the higher time frame perspective, it is okay for you to hold such kind of a trade. All right. You would be able to hold that type of a trade, knowing that the target for that trade is still our daily what? Our daily support, which is our daily support. Our daily support is somewhere right here. So this is where we are going to be targeting the market, and voila, that would have been a good trade to have taken. Okay, that would have been a good trade to have taken, and yeah. Okay, but then you took this trade based off the higher time frame, then you went to the lower time frame for further confirmation. Okay, so that is how you can use the market structure to take the trade. Now, again, let's just look at some few things again that you can look at as we are still looking at the market structure. Now, market structure does not only apply to the higher time frame, so you can still work with the 4-hour time frame and the lower time frame. Okay, so let me give you an example of this trade. Of course, it is being played in hindsight, so there's nothing fancy about it. It's just me trying to help you see what you can do. Okay, so again, we need to look at 3 levels right here. So the first level that we have is we have this one. So we have this support. Let me just readjust my chart a little bit. Okay, so we have this support right here. All right, so this is our support area. Then we have a resistance, which is this one right here. Okay, so we broke above that resistance. Then we also have this new resistance right here. So this new resistance could be reacting to this old resistance right there. Okay, so what are we supposed to see from here? Okay, so now that price is pushing to the downside, we can now take our Fibonacci from the low all the way to the high. And then now we would look for areas of interest where we could find support. So I can see that I have resistance around this area. Actually, this was the resistance. So I can use this one, and then let me just change the color. The color will be yellow. All right. Then what else did I have? I also had this one right here, which never worked. I also had, let's say, this one, which was a support, which also became, which was a resistance. Now it became a support. So these are the levels that I'm going to have. All right. So, and finally, we can also look at this one right here. Okay. So these are the levels right? That I would look at, that I would focus on. Okay, so now price is coming. Let's say price is beginning to come to that area. Now we hit, let's say we hit this area. Okay, so after we hit this area, all right, first we had this area right here, which was our support. Okay, and then price, I was actually looking for price to come to this area. So meaning that even if we had this support, price never touched this area. Okay, so now what do? Okay, I wait for this one. So once price touches this area, okay, what are we going to have? We are going to have, I'm waiting for a support to be created. All right, so the new support then is going to be, so all these things I'm going to delete. All these things are not necessary for now. And all these things are not necessary. So the next support is going to be this area right here. Okay, so now then we go to the lower time frame, which is the M30. All right, so M30, okay, we are here. And on M30, I know that price has already created some kind of resistance. So we can even pick it from this area right here. It doesn't matter, as long as I know what I'm targeting or what I'm looking at. So what I'm looking at is this resistance right here, right? This one. So let me just give it a different color to make it stand out and to make it just quite different. Okay, so there we are. All right, so now price is beginning to behave. I want to see what the market is going to do. All right, so from here, we can see that we have a push to the downside, which of course might want to fill the gap. Right, so let's see what the market is doing. Okay, so we are stuck around this area. And what time is this? This is 05 according to my time. But then we are also observing that we also have a support that is being created around this area. So price on M30 is trapped in this consolidating area. So if we break to the upside, I'll be looking for a buy. If we break to the downside, I'll be looking for a sell. All right, so let's see what the market is doing. So price is neither going up nor down, but of course, then we close to the upside. So after we close to the upside, all right, I'll naively take this buy, not naively necessarily in that sense, but I'll take that buy. And where will be my take profit? My first take profit would even be this area right here. Okay, so let us see if it goes in our favor or it hits our stop loss. I'm ready for anything. Okay, so there we start going. The market start coming down. Okay, I don't really like this type of move because it's going to hit my stop loss. Okay, so let's see. Okay, so here we are having a lot of resistance. Remember, this is a bigger time frame trade entry. All right, so I'm not taking it based off the 30 minutes. I'm taking it based off the 4 hours, which is this one. All right, so even if 30 minutes begins to show me this kind of flames right here, I know what I'm looking at. All right, because my target is an H4 structure. Okay, so that's how sometimes we tend to miss out on what the market is doing, because we tend to become so glued on the lower time frame such that we miss out on what the higher time frame is doing. All right, so that would be my trade that I would take based off this pattern right here. And of course, you saw how I broke it down and how we went for this target profit, because this target profit, remember, it was a resistance that the market never respected. That's why I was targeting it. All right, and then the overall one would be this one right here. Okay, and that would give us a very nice 1:6 risk to reward ratio. Okay, so I believe you've seen how you can work with this information and how you can trade your trades accordingly. All right, I'll see you in the next lesson. Bye-bye. Hello there. Okay, now let us look at how you can follow through the market structure on the lower time frame. Remember, what we looked at in our previous lesson was how you can map your market structure on the higher time frame and how you can also follow through your market structure on your higher time frame. So now, if you might be saying to say, I don't need to use the 4-hour time frame, I just want a lower time frame because I'm an intraday trader, I'm a scalper, etc., etc. That's not a problem. The methodology is still the same. The most important thing that you must understand is if you're able to know where your swing lows and swing highs are, then you can trade basically any time frame because the market does the same thing. Okay, so now let's get to identifying our market structure. So let's get started. Let me get my tools right here. Then let's do this. So we're going to have a high, all right, and a low. Okay, let's change the color. What color can we use? Let's use this one. All right, that's lower high. Then we have a lower low. So lower high, and then let's get, okay, lower high. Come on. Why is it not working? Oh, okay. I don't know what I'm doing. Okay, so this was a lower low. All right, so it was supposed to be this one right here. So lower high, lower low, and can say lower high. This one is lower high. We had the lower low here, lower high, lower low. Then we had the higher high, higher low, higher high, higher low. Then we had the higher, we had higher low. Okay, so right here, price pushed back, created this lower high. Then we had this lower low. Now here, let me just correct something right here. So here, if you look correctly, we never created a new high, so this one becomes the ultimate high. All right, so from that higher high, we created a lower low right here. All right, so again, let's continue. So from that, we have now a higher high. All right, so here we have a higher high, higher low. Can even say this one a higher high, higher low, higher high. All right, higher high. So can pick which one. This one, a higher low, then a higher high. Then what happens? We have a higher low, then lower high, and lower low right here. Okay, so we can even say this one is a lower high, then lower low, right? Then we continue. This becomes our lower high. All right, so let's see if we broke the low. All right, we might also say this was our lower low, then lower high, okay, and lower low right here, lower high right there, and this one is not so much clear. Lower high, I mean lower low, lower high. All right, then we have a lower low right here. Okay, lower low right here. Okay, and we have a higher high and a higher low, and also price push to create that higher high. Okay, and from there we have a higher low, then higher high, again higher low. All right. Okay, so from here you can see how the price just shoot, right? From here we had a serious shoot. So the last area that we can see to be a structure, although it's not quite clean or it's not quite clear, but it's a pause in the market, and we can consider it to be also a zone, an area of interest. We have that higher high, then a higher low, then we have a higher high right there, then we have a higher low, right? Then what else? We have a higher high like that, and we have a higher low, then we have a higher high. Can we pick this one as a higher low, higher high? This one, higher high, higher low, then continue, higher high, then higher low, higher high. Okay, and what else? We have a higher low, okay, and then a higher high. Then right here we had a higher low, Then, of course, we had a higher high. All right, so this is how you map your structure. And of course, you'd see how powerful we have managed to map our market structure. Okay, so now with this in mind, let's say if you are looking for a trade, okay, you're looking for a trade. Remember, once we see a break of structure, we start now waiting for price to do something. Okay, all right. So let's just cut the chart from right there. We can even cut it from even right here. It's okay. Can even cut it from right here. So in fact, even from right here, it's okay. So I want us to have enough time to work this so that we see how we can go about it. So now we are in this range from this low to that high. So what will be your major levels of structure? So this one here, it's going to be my major level of structure. All right. So again, let's just change some settings here so that we can have something that is working for us best. Right. So that will be my level of structure. Then my other level of structure will be here. Right. So this one will be my other level of structure. And after we have these two levels of structure, then I'm also going to have internal levels of structure like this one. Okay, so this one came right here. Okay, came right here. It was more of a break and retest. So we're just going to change the color since it is part of internal structure. All right, so we're just going to give it a pale color like that one. Okay, so since it is part of internal structure, we can just give it that color. All right. Then, okay, the next thing that I want us to look at is we also have quite a number of things going on right here. We have also this level, which was not touched. Okay, so are we going to have a bar replay? I believe no, because I think this account has expired. So let's see what we can do. Okay, just waiting. Okay, so we are back. I think things are now normal. All right, so we are just going to work with what we have. All right, seems the market can't, I mean, the trading view that I have seems to have expired. So now we have this one, that one, and the major one will be this one right here. So of all the three, two of them must be tested out. If price doesn't test anyone that is going to be our major area, then of course it must test another area. Okay, so price pushes, then it comes into this area. Now remember, this area is not just a single line, but rather a zone. So what we can do is we can think of this area as a zone. Okay, that's the thing that you need to do. Think of it as a zone. Then after that, you can see that on the lower time frame, as price came to this area, what was the market doing? All right, so we can begin to also see that there was an area right here which was not so much as of tested by the market. So price seemed to have come back to that area. Okay, so price now is around this area, and what we begin to see is that now the market begins to do what? Market begins to create a form of a form of support around that area, and then that support is also being tested out by the market. So that support is also being tested out by the market. All right, so the next thing that then we need to see is from here, we need to wait for a candlestick confirmation. So why am I looking for a candlestick confirmation? I'm looking for a candlestick confirmation because you can just enter a trade without proper confirmation. So where are we in price? This is 9th October. Hopefully we get there on the lower time frame. That is on M15 for our entries. Okay, so let me put a vertical line around this area. Okay, so there is our vertical line. Let me make it a little bit big. Okay, so there is our vertical line. Then I can go to M15 from that area. Okay, so M15, let's look at what price looks like on M15. Okay, so where are we? Let's see. Are we able to get there? Okay, so yeah, we are able to get there. Nice. We are able to get there. So now, this is our M15. So we have looked at the area on the lower time frame. So we have established that now we have broken that area. All right. So we can now get to the lower time frame. Okay. So once we break out of that area, again, what do we see here? All right. So we might also as well begin to see that we were creating some kind of structure. So we had the low. Okay. Let me just change the color for this one. Okay, blue, and then high, then higher low, then we have the higher high. All right, so then price should come around this area. Okay, so once price comes around this area, what we want to see is a candlestick pattern, and already price then gives us this candlestick pattern, which is a bullish engulfing. So you can see how big this candlestick pattern is. It's a bullish engulfing about 2 candles. All right, and our stop loss can just be below this candle right there. Then our first take profit from this trade will be targeting this high. All right, we'll be targeting that high. Okay, so if price hits our take profit of that high, then we can now begin to look for more areas of interest to target. So that will be our first take profit. Of course, then we'll go back to the 1 hour time frame and we can let the market flow. Okay, so let's say that was our first trade that was taken based off what we have just looked at. So here we had a support area that was being created by the market. And then after the market created that support area, then what happened? Price then just shoot to the upside. Okay, so we break the structure. Then we go back to the 30 minutes again. Okay, so in this time frame, I mean, in this lesson here, we're going to do a lot of, moving about with our charts. All right. Okay, so what happens here? We push, we create that high, then we pull back. Now, if you can see, the market had a support area there. So we had our support area created around that area. Okay, so that is a minor support. Why? Because now, all right, if we forget about these areas, then what areas are we going to be looking at? What areas are we going to be focusing on? So let's say this one we remove, this one is not important. So the next area or the next area of interest that we'll be looking at will be this one right here. Okay, so let's just make it black. So that will be the area. Why would that area be important? Because now this is the higher low that created that higher high. So we have this one, that one, and also we have this one right here. Okay, perfect. Okay, perfect. All right. I believe you are seeing how I am approaching it. Okay, so now there are 2 things that I would want to see the market to do. All right. So the first thing will be to see the market pull back into this area. Of course, we can, at this point, we can even use our Fibonacci from this low all the way to that high. Yeah, the Fibonacci is quite important. You need to use it at all times. All right. Even though on this previous one, I didn't use it, but use the Fibonacci at all times, all right, to help you see which potential areas of interest the market could be retracing back to, all right? So, yeah, can use the Fibonacci, very important. So, let's see here. The market seems to have reversed to 0.236. All right, but my good areas where I would want to buy is this resistance right here. Have you seen this resistance? Or let me just highlight it with okay, let me add a different trend line. All right, something like this one. Okay, and let me give this one a different color. All right, so let's say I would want the market to come to this area right here. Okay, this area right there. So let me just fix it so that I avoid the aspect of changing the colors like I'm usually doing. Okay, so that's where I would expect the market to come to. At least it aligns with 61.8 or 0.618. It aligns, right? So that is the area I would look to see. But anyway, price can reverse from any area. So let's say price comes to this area. Now, why is this area important? Because it's a support. You can see price came, created a black candle, then a blue candle, then price went to the upside. All right, so now the market is coming back to this area. Now, as the market comes back to this area, we need to study the price very well. What is price doing? Okay, so we can see that we have this hanging man, all right, a bullish hanging man right here, all right? So this signifies that the bearish momentum is changing and now buyers are getting into the market. But then we cannot just take a trade based off that, all right? So the best thing that we can do is to see bullish candles come in. All right, so once I see this bullish candle, I would want to take the trade, all right, because obviously we are going to have, let me just move. Let me just, I'm trying to shift this. Anyway, it's okay. So, what we need to see is, you can see price created that pin bar right there, and then we broke above it. Okay, so there are two ways in which you can take this trade. You can take this trade upon the close of that candle, all right? This huge candle here. Or you can take the trade upon you seeing this bearish momentum come into the market. All right, so whichever is going to give you a good risk to reward, it's okay. That's the one that you go for. So this one, then where am I going to put my stop loss? I can just put my stop loss below these wicks down here. And my first take profit will be here, all right? Then my can let the market run, or I'll target my 1s to 3. All right, I'll target my 1s to 3, which means that I can even target my 1s to 3 right there. So if we let the market run, that is how much it would give us, a 1s to 6. Okay, that's perfect. Okay, so perfect. So now we are moving on with the market. All right, we are moving on with the market. We are moving on with our market structure. So we have now a higher low. All right, so these odd areas, we could delete them or we could just leave them like that. Okay, sometimes price can come back to these areas and try to retest those areas. You never know. All right, you never know. So sometimes price can just try to come back to these areas like that, where price comes back to this one here. All right, you never know. Okay, so you can as well leave them on the chart and see what the market is going to do. Okay, now the next thing that we see is price breaks. Then as price is breaking, we are going to have another one, which is right here. Okay, so this is another area that we are going to have. Now price pulls back, and then after price pulls back, I would expect it to come down here. So what am I going to do? I'll get my Fibonacci from this low to that high and see where price is coming back to. So price is coming back to the 50% of the zone, 50% of the zone. So now from there, what would be my approach be like? Okay, so here, I want to see price store around that area. I want to see price begin to build some kind of support around that area. Okay, so what is the sign that the market is beginning to build support? So you can see we have something going on right there. Okay, so I can even remove this Fibonacci. So here we had a bearish candle, a bullish candle, then price came back again, retested this area a couple of times, and then the market pushed to the upside. Now, again, what happened here is that price came and retested this area, failed to break it, then came back down. All right. So obviously here we could have taken a sell based off the fact that the market could not break. This area's resistance was still there, you know, sellers were still there, so we could have taken a sell. But then we also have a support right here. So for me, my approach would be to buy the market. I wouldn't be so comfortable selling from there, even though it's a sell, but it would be more like me trading against the trend of the market, which is not ideal in this situation. All right, so let's say the market comes here, it gives us a pin bar. Looking at how the market closes with that pin bar, if we were to go on the lower time frame, of course, because of time, we may not have the luxury to go there. All right, so what am I going to do? I'm going to look for the entry. So the entry could either be here, depending on how comfortable you are with your stop loss. So you could put it right there. All right, and then just put your stop loss down below this candlestick or below this candle right here. Okay, so, and if you want to get a 1 to 3, it can become quite tricky. You may not even get a 1. Oh, okay, you may get a 1 to 3 like that, but it will come at a very serious time or serious cost. All right, you have to be patient and wait for all that to happen. Okay, now what is going on here? So we have the next one is this one here, and the other one is going to be this one right here. Okay, so here this is going to be our resistance, and then down here we are going to have our support. So this orange line, this blue line there, is going to disappear. Then we can add another line, which is this one. All right, now what am I expecting to see? I'm expecting to see the market to come here, all right, create a lower low, a higher low. But then what we see is the market fails to respect that. Of course, it comes here, respect it. Obviously, there might have been some few trades taken right there, which is okay. But then what we can see is price fails to give us those highs. Then what happened? We see the market begins to drop aggressively. So what am I going to have? I'm going to have this area, which then becomes my resistance. Okay, I've used the wrong two. Okay, I want to move this one here. Okay, let's do this. Oh, okay, it seems like it doesn't want to move. Okay, so we have a resistance right here. Now, with this resistance, what I want you to see is price comes down, comes back to that area, then it retests that area. Then upon retesting, you can see we have a big Marubozu candle, all right? A big Marubozu candle. And of course, we had this indecision candle right there. Okay, so that's an indecision candle right there. And then we have a huge Marubozu. Okay, so depending with what you want to do, okay, the fact that we had a break above and this also candle closing above might be intimidating to take a trade. That's where now we might want to see the market to close below. So once that happens, then we may as well, it's not a good entry, yeah, but it's going to be the safest entry that you can take, okay? And the target is going to be just right here. Right, so it may not be a good entry, but then we can begin to work with our stop loss in order just to maximize our risk. Okay, so that is going to be a trade that you can take right there. Then price again comes to, remember, we never tested this area, so it was still fresh, and this is exactly where the market comes back. So now in this situation, the market is already downtrend. All right, market is downtrend. So what am I going to start thinking? Okay, what I'll start thinking then is that if we created this lower low, then lower high, then we have created another lower low, then this will no longer be a blue line, it will be my structure. So I may even pick it from which one, just here, because I need to see proper structure formed. So I may even pick it from there. Okay, so now that this has happened, what am I gonna do next? Okay, so what I'm going to do next is where I wait for price to pull back to that area. Okay, so of course we are going to have which area? We're going to have this one is going to become our new area. All right, and now let me just delete some of these areas that we don't need. We don't need these lines right here. All these lines, we don't need them. And also, obviously, this one, we don't need it. We needed this one right here. Yeah, we needed it. And obviously this one was never retested, so we might need it in the future. Okay, so price, also this one on top, we need it because it has not yet been used up. Okay, it is still a fresh area. Okay, so price creates this low, which is a fresh area, then reacts off of this one, which was not used up. Then let's look at the type of candlesticks that are formed right here, because it internally, we begin to create this area. All right. So this becomes our resistance. Price pushes to the downside. At the same time, we still have this as our resistance right here. I don't know why I keep using this. Okay, we still have our support, which is right here. Okay, so now price comes to this area, all right, and then reacts off of that area. Then it gives us a bullish engulfing. Now, after price gives us a bullish engulfing, all right, you can see it's pin bar. Then we have this candle close above. Even the next candle closes as a pin bar. So now what we can do is we can get our entry right there based off that candlestick, then put our stop loss just below. Where will be our target? Our first target will be this one, all right? Second target will be, of course, targeting that high. Now, this is, okay, it's a good trade based off the fact that it went and hit our take profit, but then it will be trading against the trend. Where is the trend? The trend is downtrend. So if you have noticed very well, it is from this high. Okay, let me get my fib. So it's from this high all the way to this low. So price was just pulling back, and we never had any confirmation on these levels until we got here, all right, until we got somewhere here. So here, this is where we had the confirmation. You might ask to say, hey, but where is the confirmation? All right, okay, so actually we had two. The first was this one here, where we had this candle, though it never worked out so well. Then price came and gave us a second one, which is this one. So this is a bearish engulfing. All right, so this is a bearish engulfing. So again, on this area, you can almost see that we had some kind of resistance. Where was the resistance? It was here. All right, so we had this resistance right there. Okay, so after we had this resistance, price broke into it. So we broke up. We were supposed to respect it. Then price broke, and then we went down, and then price came for a retest. Then after a retest, we had this huge candle down here. All right, so this huge candle down there, okay, is going to usher us into another level, all right, where we can pick a trade. Okay, now this is where now you familiarize yourself with the concept that I shared with you of how to, you know, look for, you know, support and resistance. All right, so that is what is working for me right here. So, and if you go through this work, it will also produce for you wonders. So this was a resistance which was broken, then price came, retested it, then we broke above it, then price came back to it, and from there we might even want to take a trade, but of course based off this confirmation candle. So what we want is to see sellers come into the market. So where will be our take profit? We'll target this area right here. So this is where will be our take profit, our first take profit. Okay, first take profit. All right, and of course there'll be a lot of things going on here. So you can see we had quite a number of, you know, activities going on, a lot of things going on here. We had another, you know, break and retest. Okay, you can see that one right there. We had a minor support, then price broke, then we put back, then we pushed again to the downside. All right, so a lot was going on, but yeah, knowing where your trend is going, you'll be able to catch this sell, a clean sell. All right, be able to catch that clean sell. Okay, so now we create price comes to this support, then look at how price respected that support. Okay, look at how it came and played around that support. Then what happened? We had a push to the upside. Okay, so now that we had a push to the upside, where is the market going back to? Yeah, it is coming back to this. So now this has been used up, right? Okay, we no longer need it. What we now need is this right here. Okay, and what else do we need? So we need that one. This one, we don't need it. We don't need this line right here. What we need is this one right here. Okay, and what else do we need? So we had a low. Okay, even this one, because it's the one that created the low. All right, this one, it's the one that created the low that we came and broke. Okay, so yeah, though it has been used up, so that's the reason why I said we don't need it. So now price pushes to the downside. Then what do? We can now pick our fib from this high all the way to the downside. Okay, all the way to the downside. And then now what do we have? So you can see price came to a number of levels. It kept on breaking because there was no confirmation until price comes here. Then it gives us this is what we call a tweezer top. All right, tweezer top. We can see how equal these highs are. So it's a tweezer top. All right, tweezer top, then price pushes to the downside. Now that to us is a powerful confirmation. All right, based on the candlestick patterns. Like I said, we never looked at the tweezer tops and the tweezer bottoms, but you can look up all this information because the tweezer tops and the tweezer bottoms, they rarely happen or they rarely occur in the market. All right. So now let us look at what happens. Price pushes, then it continues to push. All right. Then it gives us this. Okay, so if we are looking for the entry, where would be the best place to take an entry? That's a good question. So for me, I would wait to see a resistance created. Okay, resistance created, and I would keep tracking my resistance. All right, so here is a resistance that was created, then it was broken. Remember, we had a bullish candle, then a bearish candle, resistance created, price pushed up, price pushed down, then came back to a retest. Okay, so for me, right about that area, I'll then begin to look for what? For entries. And also down here, we had this support that was created. Okay, so support here, price retested it, then we broke up below it, then obviously price might have come back to this support. Okay, so the first thing that I want to see is once price comes to any of these areas, I want to see confirmation. So here we have this bearish candlestick, which closes as a bearish candlestick right there. Okay, so again, that on its own ushers in another level of what? Of resistance. Okay, so if price pushes like that, I would, of course, get into a trade right here. All right, so my trade would be, okay, the open of the next candle. My stop loss will just be above, which is quite big. All right, and the take profit is quite too small. So I wouldn't advise one to take this trade because already we have missed it from here. And okay, we have missed it from here. Okay, so if we were to take the trade, it's just that from here we never had proper confirmation. But if you can see how price is reacting, so if we have this, then we can even say, okay, my stop loss can just be above right there. And still, a 1 to 2 is not bad for a trade. But then if we know that the market will continue dropping, we can even target this area. Why are we targeting this area? Because it was never tested by the market. All right, so price can as well just come to that area and test it out. Okay, so now we break to the downside. What else are we looking at now? Okay, so we are done with this area. The next area that we can look out for is this one right here. Okay, so from there, and also we have this one, and where will be our next area of interest? So our next area would be, of course, it will be this one here. Okay, so these are the 3 areas. So even this one here, so these will be the 3 areas. So here we are done with these. Whatever we are done with, we can just delete them so that the chart continues being clear. All right, so now our focus would be this range from that high all the way to this low. All right, so that will be our next focus. So again, what do? I'll go to the Fibonacci, put my Fibonacci there, then to get to the low. Then from here, I'll then start looking for where price could react from. Okay, so first and foremost, I would love to see that we have a resistance right here, which is quite interesting. And it is between 50 and 61.8. Okay, so that would be the area that I would be looking for. Then the other thing that I would also notice is also we have another support right here. Okay, so based off this, I can even remove the Fibonacci, and then I would just wait for confirmation, because what we want to see is confirmation. And of course, I believe if I took this trade, I would hit my stop loss before hitting my take profit. Okay, so why do I mean this? What do I mean? Okay, what do I mean by this? What I mean by this is if I took this trade, okay, because obviously I would take it based off the closure of this candle, all right, which creates an evening star. You can see a bullish candle, then we have a kind of a doji, then we have this bearish candlestick down here. So I would take that, and obviously my stop loss will just be above right here. So if my stop loss is gonna be above right there, okay, if my stop loss is above right there, and let's say I was targeting a 1 to 3, it would hit my my stop loss. Okay, it would hit my my stop loss first. Okay, so like I said, again, there's no holy grail of trading. So if that happens, we go back again. So again, we wait, look for this one, look at this one, the way it closed. It closed with a huge rejection. And of course, take an entry right there. Put the stop loss above. Then, of course, target 1 to 3. All right, so 1 to 3 will be somewhere away. Somewhere here. Okay, somewhere over here. All right, that will be a 1 to 3. All right, and yeah, that's how you can approach this market. And of course, just following through the methodology that I have shared with you, you are able to track the trades that you can take. All right, so of course there could be quite a number of trades, but then it would require patience from your side, because what I'm offering you is not a holy grail of trading. It requires a lot of patience and a lot of practice on your side. Like, you really need to practice this thing. All right, look at this. We have a retest, then again price comes back, closes like this. That's a trade. Okay, so I'm not promising you a holy grail. Again, let me repeat that, because you may think this is a holy grail. It's not. It requires a lot of work. Come on, what am I doing? Okay, so it's not. It requires a lot of work. Right, it requires a lot of work to be able to see these things and just understand everything that I am doing. All right, so I leave it here, and you may do the rest on your own and see how well it will come out. I'll see you in the next lesson. Hello there. Okay, let's now get to the very end of our course as we wrap up everything. So a course is not effective without the entries and the exits. However, as we have been looking at everything that we began to look at from the time that we started this course and from the time that we started going through it, you may have observed that I've given you a lot of entry examples, and those are the exact entries that I take. It's not about taking a sniper entry where you want to predict the bottom of the market, where you want to see the market, where the market is going to turn around from. But it's all about getting a trade that you have clear confidence about, a trade that you know, if I took this one, I know how much I'm willing to risk on this trade, and I'm comfortable with the risk that I am going to take on this trade. Okay, So when it comes to entries, we use basically we use candlestick patterns, nothing complicated, just candlestick patterns. Like I said, the goal of this strategy is not to make things complicated, but just to make things easy in a way that you are going to understand. Okay, that's the whole purpose. And that's the reason why I'm trying by all means to make it very easy so that you see how well you can approach this strategy. And I believe that if you go through everything that we have looked at and put it to work, backtest it, you'll see how well it is going to work. Okay, so what are the entry criteria that we use on this strategy? So let me give an example. So let's say the market is in an uptrend. So you are tracking, let's say, a 4-hour market structure. All right. So you're tracking the 4-hour market structure. So this is the 4-hour market structure. All right. So this is the 4-hour, all right, market structure. Then you have identified your major levels of interest. Your support is right here. And you have also identified your resistance right here. And you know that the market is in an uptrend. Okay. The market is in an uptrend. So here is where the market is on H4. And let's say it is right here. It is coming from here. It is going up. All right. How are you going to take a trade? So first and foremost, you need to know your structure very well. So obviously, you cannot just have one high and one low and call it a structure. Obviously, you need to have several highs and several lows. All right. So let's say we have this for structure, meaning that price, you're able to see that we broke structure to the upside, and we are now in this range right here. So technically, you have this as your range and that high, and also of course you have this area right here. Okay, you have this area right here. Okay, so these will be your 3 levels of interest. Okay, so you've got this one, which was a resistance, which has been broken, and you have this one also, and you have that one, and then this one, then it's going to be internal structure. So we are going to give it a different color. So let's say price is right here. Okay, so now what do you do? Okay, what do you do? All right, so if you go, let's say you go to your 30 minutes time frame from the 4 hours, you go to your 30 minutes or 1 hour or M15, you may observe that even right here, the market has been creating some kind of things. And, you know, let's say the market is doing this. All right. So quite all right. You are going to identify your internal structures. You're going to identify your internal levels. Let's say this internally was a level. All right. This internally is a level, and also this was a support. All right. So now we have this area where price is approaching this area. So what am I going to do? If my target is this H4 structure, right? There are things that I would do. Of course, obviously, I can take a trade from here. All right, targeting this area and also targeting that high. But then what would be the confirmation? So if I move from the higher time frame, then I go to the lower time frame, I'll begin to see this. So on the lower time frame, what am I looking for? I'm looking for entry confirmations. So what are the confirmations? So the confirmations could be a bullish engulfing pattern. So let me just give an example. It could be a bullish engulfing pattern. So let's say this one is a bearish candlestick, right? So this one is a bearish candlestick. So it could be a bullish engulfing pattern. So a bullish engulfing pattern would look something like this. Okay, so a bullish engulfing pattern would look something like this. Okay, so a bullish engulfing pattern will look something like this. So I would look for a bullish engulfing pattern around that area. So this will be my entry criteria. So if I can find this type of a pattern around the support or around the resistance, then that is going to be my entry. All right, that is going to be my entry. The other pattern that I'm going to look at, in fact, just refer to the the lesson on candlestick patterns, and you are going to find those kind of patterns that we were looking at. Okay, so the other pattern that I'll look for will be a bullish pin bar. All right, I'll also look for a bullish pin bar around that area, making sure that it closes as a green candle. But if it closes as a red candle, I'll then look for further confirmation. So I'll look for also this kind of a pattern, and then I'll also look for maybe the hanging man. All right, but then again with the hanging man, it follows that it has to also close. It also follows that it has to at least have another candlestick just for confirmation. All right, that's what it follows. So if it closes like this, then I would want to see another candlestick like this. Now these are just confirmation candlesticks, so I would want to see another candlestick like this, and then yeah, it closes above so that it engulfs that type of a pattern. All right, so I'd want to see another candlestick like that. Okay, so these are the type of candlestick. I'll look at this one, I'll then look at this one, look at this one, also look at this pattern, and also other patterns that may be there. So refer to the lesson on candlestick patterns and try to understand them well, and also look at other type of examples that I gave when we began to look at market structure, the technical analysis, etc., etc. So that will help you. So basically we need to look for candlestick patterns on lower time frame. All right, that would then help us to take those entries or those refined entries. So when you have a higher time frame market structure, then you can scale down to lower time frames to start looking for patterns that may begin to emerge. All right, supply, support, and resistance areas that may begin to show up, where now you may start now looking for those lower time frame entry candlesticks. Okay, so let me just give you an idea. Let me just show you what I'm talking about on the live chat. I'll see you in the next lesson. Hello there. Okay, welcome to this lesson. Now, this lesson, I'm going to give you a practical example of how you can take an entry on the market. Now, first and foremost, we need to look at the market structure. All right, so I'm using a 4-hour time frame, and from the 4-hour time frame, we can see we had the higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high. So basically what the market is doing is that it is pushing to the upside. So what are we expecting to see? We are expecting to see some buying opportunities. All right, so let's say we are here and price is pulling back. All right, let's pretend that this has not yet happened. So we are here, price is just pulling back. And what things am I going to identify first? I can see I have something like a support right here, right? So I'll be watching to see how price comes around this area. Now, as price comes around that area, and if it begins to create more support areas as a result of the market coming to that area, then I'll know that, okay, buying opportunities may be coming through. All right, so what do I see? I begin to see a lot of support being created by the market right here. All right, so price then begin to create a lot of support. So we had this one, then we have this one right here around this area right there. Okay, that is great. So now from there, I'll then move immediately to the lower time frame. Okay, so on the lower time frame, that is on the M30. All right, what I want to see now is to see how price has been behaving. Now, remember, we have, this is our support area. Okay, so what is the market now beginning to do around this area? So this is where you zoom in and you start looking at, internal structure. You start comparing what you're seeing internally and what is happening externally. So internally, we had this resistance right here, where exactly price came back to. And from there, there was, of course, some nice selling opportunities. But then we can also see price started pushing up, created this support right here. All right. So we can say this one is the most clear one right here. So we can say we have this as our support area. All right. So this is our support area now. So once price pushes, comes back, what you want to see around this area is a candlestick pattern or a candlestick confirmation pattern. All right, because the moment the market, because around here you see a lot of things going on such that you'll be confused as to what is really going on. All right, so we need to be patient. All right, sometimes we'll take losses, sometimes we'll take wins. It's all part of the game. All right, okay, so you observe that a lot is going on. We have this resistance here, right, which was reacted on, then price came, it acted as a support, some support again, it came and completely, reacted as a resistance. So let's say price, all of these things have happened and we are yet to take a trade. Okay, so what trade are you going to take? Because what we want is clear price action. So you can see there's so much noise going on here, right? Even right here, so much noise going on, except that we see that now the market begins to do what? Now the market begins to reject this area. Okay, so once price rejects this area, okay, so let's say, what time is this? Okay, this is around 6 p.m. my time. All right, so once price begins to reject this area, it's a clue that something is about to happen. But then I would want to see price break above this area. I want to see price break above this area, because this to me becomes a resistance that must go. Okay, let me use the appropriate area. So this to me becomes the resistance that must go. So I'm not just going to say I'm taking a trade without thinking about what is really going on. I am full aware that we have a resistance around this area. Price is being resisted from going up. Okay, so I'll wait for price to break. Okay, I'll wait for that price to break. So once price breaks that area, all right, then it gives me a signal that we might start looking for some buying opportunities. Then, of course, I'll still be looking for areas of interest which could potentially be used by the market. So you can see we had this resistance here, support, and a lot of activities were going on here until price came back here. All right, so as the market comes back here, all right, as the market comes back here, what am I going to look for? Of course, I'm going to look for entries. All right, so you may say, okay, I can take a trade right here. Yeah, there's no problem. There's no harm in taking a trade right here. You can take a trade right here as long as you have good confirmation. All right, as long as the market gives you some solid confirmation, you can take a trade from there. But then if the market hasn't given you some solid confirmation, don't. All right, because that's the purpose for this class. So you can see here we had a candlestick, which is this one. Then we engulfed it with this candlestick right there. Okay, so that is a perfect example. All right, so from here, if you're waking up and then you find this, then you can take a trade right here. Then you put your stop loss below here. Then your take profit should be, your first take profit should be this high, because this is the resistance. And we see how price has been failing to break that area. So that's your first take profit. Okay, so now if you do further analysis and you're trying to find out which areas are still, which areas still needs to be used up by the market, etc., etc. So you can say we had this resistance here, and it was also touched here as support. So we had a lot of reaction on this area. So if price comes back to it, the next thing that I want to see is an engulfing candle. So there you have it, engulfing candle. So once you have that engulfing candle, then you can take your entry right here. Of course, the first thing that the market will do is take you into a drawdown, which sometimes it hurts to see a drawdown. So your first target profit will be this area right here, which is a 1-to-1. Then after that, you can even target maybe that high right there. Okay, and that is going to give you a 1-to-4. And if that is a good trade, you can even hold until you see how far the market begins to go, until maybe structure or candlestick patterns begin to change. Okay, so basically your entry patterns, your entry criteria should be based on candlestick patterns. All right, should be based on candlestick patterns. So here we are. Okay, this is a resistance that was created from the higher time frame. Then price comes here, all right, plays around this area, tries to push to the upside, then comes, rejects this area, then begins to shoot. All right. Again, comes and creates what is happening. It comes and create another support. All right. So what we have is initially we have this support that was created. All right. On the lower time frame, we also have this resistance that was created right there. Okay. So price pushes, then comes down, retest the support. So support, support, retest, and then we have a pin bar right here. Then after we have a pin bar, you can see we had some form of resistance right here, which could be a very, very, very small resistance right there. Then what happens? Price breaks that resistance, then comes for a retest. Of course, you can even take a trade from there. All right, you can take a trade upon price coming for that retest of the resistance. You put your stop loss down here. And where would you put your take profit? Take profit would be to target the previous high. Which one would be the previous high? So you'll be targeting this area right here. Okay, so from there, if you enter that trade, you'll be targeting that high right there. Okay, so how again did you enter this trade? You entered it based off the fact that here we had a support. Then we also had this small resistance right here, which was created, then price broke it. Then there was a retest of that area. Then you entered on the retest, and your first target would have been this area, of course, but your overall target would be that high. Okay, so that would be your entry. Okay, that would be your entry. All right. And let's look at what price is currently doing, and let's see how you can take advantage or enter the trade right here. Okay, so again, we go H4 time frame. H4 time frame, what is really going on? We have, for me, what I can see is that I have this high right here, which is my resistance. Then what is my support? My support is right here. Okay, so I have a support and I have a resistance already. Okay, so this is my areas of interest. All right, so now that I have these two areas of interest, what then am I going to look out for? What am I going to look out for? So I'm going now to go to my lowest time frame, which is the M30, and then on the M30, all right, I'm going to look out for something quite interesting. And what are those things? I'm going to look out for internal structure. All right, so internal structure to me is very, very important. I can't ignore the fact that we need to have internal structure. So we had this support right here, okay, which was violated around here. So we had this support, and then also, what is it that I can see? We also have around here, we have a resistance, or around here, we have a resistance. So this is a resistance that has not yet been targeted. And also, again, you can see we have another kind of support right here. All right. Okay, so we had resistance, support, then we break it, then price again pulls back to a new resistance, which is right here. All right, so we break it, then we pull back to that resistance. Then what happens? We have another one, which is right here. Okay, then after we have this one, what is going on here? We see price breaks, again creates another resistance here. So for me, I'm not focusing so much on these ones. I'm not focusing so much on this one. I'll be focusing on, I'm not focusing so much on that, right? I'm not focusing so much on that, but I can focus on this one right here. Okay, so what is going on here? Price pushes, then is resisted, and price comes back for a retest. So once we have that retest, what then happens? The market drops. All right, then price then tries to push there. So this is where now we can go even on the lower time frame, like as far as M5. Okay, so if we look at the M5 critically, we can see then that here the market came back to this area. Then from that area, there was a huge push to the downside. But then if you didn't catch this drop, you can still catch this sell right here. And based off the closure of this candle, you can then place your entry. So entry right there, take profit, stop loss above. Then take profit, of course, you target this low, and it's going to give you a 1 to 3. So it looks like it's an easy trade, yeah, because of the fact that You have followed all the methodology, you have followed everything that we have looked at. Okay, so that will be a very nice sell trade. So currently on M5, we have this as our support. In fact, let me just take it back to M15. We have that as our support. So support is here. And so far, we have not violated this support, all right? So far, we have not violated this support. And what am I looking at? What I'm looking at is, I'm looking at the resistance that is forming right here. So if this resistance is broken, all right? If this resistance is broken, then we're going to push to the upside. All right, so that is what is happening right here. Come on. That is what is happening right here. So we have this resistance that is trying to form right here. We've got the support here, we've got the resistance right here. So my goal is to see how price behaves around this area. So if it breaks above, let's say a new candle starts and pushes above, then we are going to maximize on that one. All right. So, or if the market comes and breaks below, then we are going to look for some selling opportunities. So this is where the market is. I believe it makes sense. Okay. I'll see you in the next video. All right, welcome to this last and final lesson of our strategy and of our course. And in this lesson, it's not going to be very, very, very big. It's just going to be about risk to reward ratio. Now, if you have observed me from the start of our lessons, all right, or from the start of the course, I've been looking at, you know, the risk to reward. I've been talking so much about the risk to reward. Why is it important to have a good risk to reward? Okay, here is the secret of using a good risk to reward, because if you have a good risk to reward, that is going to help you to at least be on the winning side, regardless of how bad your strategy may be. Okay, so for me, my average risk to reward is just a 1 to 3. Why? Because it's easy to hit a 1 to 3, whether I'm trading from the higher time frame or I'm trading from the lower time frame, than it is to hit a 1 to 10, a 1 to 20, a 1 to 30. Okay, so having a 1 to 3 with a strategy which wins, let's say 5 times, or which is 50% accurate, all right, is something that is going to really, really is something that is going to still make me profitable over a long period of time. Why? Because imagine if I can win 5 times, that means in those 5 wins, I'm going to have 5 times 3, I'm going to have 15 ARA. And then if I can lose 5 trades, all right, those 5 trades that I'm going to lose is going just to be equal to 5 ARA. So if you subtract 5 from 15, I'm still going to be up 15 ARA. You see, so it doesn't matter whether I lose 5 trades, all right? The most important thing is that I'll still end up being profitable. You know, that's the good thing about this. I'll still end up being profitable, okay? I'll still end up being profitable. That's the good thing about this, okay? And that's also one of the things that I would love for you to do what? To adopt. All right. That's one thing that I would love for you to adopt. Okay. So if you have observed our strategy, it is winning and it is losing. We can't avoid the aspect of losing. Trying to avoid losses in trading is like, you know, you just want to be the market maker, which is not practically possible. Any strategy that you're ever going to come across on the market are not going to give you 100% win rate. There is no 100% win rate strategy. The only thing that we do in Forex is to manage our risks very well and also to know how to use the risk to reward. So the risk to reward, what that means is that your risk versus your reward. So here, it shows you how much you are willing to risk. So here it shows you your risk, and then down here, it shows you your reward. So here is your reward. Okay, same applies to this other one right here. Same applies to this other one right here. This one is going to be your risk, and then this other one here is going to be your reward. Okay, reward, like that. Okay, so if you're buying, like I said, make sure that your average risk to reward is going to be a 1:3. Okay. If you're selling, make sure that your average risk to reward is going to be a 1:3, because it's easy to hit a 1:3 than to hit a 1:4, a 1:5, because the market can turn anytime. All right, anywhere it can turn. And from our lecture so far, you've seen how sometimes the market could just turn and hit our stop loss. Maybe it gave us a 1:2, then it just reverses, fails to hit a 1:3, then it reverses, goes and hit your stop loss and all those things. And no one would want to be losing money. Losing money is hectic, but then we can't avoid the aspect of losing money. The only thing that we can do is control our minds, our mindset, even as we are in a losing trade, because we know that in the long run, all right, if we look at the sample size that we have backtested, and if you see that, okay, my strategy is winning 5 times out of 10, it's winning 6 times out of 10, then you are good. You see, you are good. That 6 times, if you multiply it by 3, all right, is something that is going to be very huge, because 6 times 3 is somewhere 18 ARA. All right, so if you lose 4 times, so 18 ARA minus 4, okay, that's going to be somewhere 14 ARA. Okay, somewhere 14 ARA. So 14 ARA is something that is good if you're trading a prop firm account. All right, if you're trading a prop firm account with 14 ARA, you would have already passed your prop firm. You see, if you maintain your discipline on your risk to reward, if you don't play around your risk, then you are going to be good. And what am I going to, why am I saying this? So risk management, okay, comes also down to how much are you willing to risk. So risk management comes down to how much you are willing to risk per trade. So let's say if my risk management, if let's say I'm risking 1% of my trades, all right, I'm risking 1%. Okay, so let's say risking 1% of my account. Okay, so meaning that each time I take a stop loss hit, I'm going to lose 1%. All right, so each time, so let's say each time I take an SL, each time I take SL means stop loss, I'll lose negative 1%. So you see, lose negative 1%. And then each time I take TP, which is take profit, I'm going to gain 3%. Now look at the difference. Look at the difference. So if I win each trade, I lose 1. I win 1, I lose 1. All right, that's a 50%. That's a 50% win rate. Okay, so let's say 50% win rate. Win rate. Okay, so if I lose 1 trade, I win 2 trades. Okay, I take 2 trades, I lose 1, I win 1. That's a 50% win rate. Okay, what would be my overall ARA? So overall ARA, which is my reward, is going to be plus 2%. Okay, now isn't this good? I won 1, I lost 1, but I'm still up 2%. Now let's say if I took how many trades? So if I took 10 consecutive trades, 10 trades, okay, then I lose 5 and I win 5. Okay, so what would be your ARA? So if I'm still maintaining a risk percent of 1%, so that means I will lose about negative 5%. Okay, so negative 5%. All right, then I will win. So I will win. Okay, positive. Now 5 times 3. All right, 5 times 3 is going to be 15 ARA. So I'll be up 15%. Now, what will be my overall? So overall ARA will be equal to 15% minus 5%. It's going to give you what? It's going to give you 10%. So meaning that if you are trading a pro firm already with 50% win rate, you would still pass your challenge. If you hold on to your risk to reward, you don't change the numbers. You don't change the numbers. All right. And if you say, because nowadays pro firms, they have removed these things to do with, what do they call them? Daily limits, etc., etc. So if you're just patient and you're taking the trades which aligns with your strategy and the things that we have looked at, of course, you would still win. You would still pass your pro firm. You would still pass your even if the win rate was 40%. Okay, even if the win rate was 40%. Okay, let's say you lose 2 trades and you win 1, you still be up by 1%. So 1%, if you won 4 trades, 1 by 4 is going to still give you 4% up. All right, 4% up. Yeah, you'll be down 6%, but 4% up. All right, meaning that still you are not going to blow your account. All right, so this is the importance of risk management. Now, for you, you can see how you can work around with these numbers. If you can take a 0.5% risk, it will still give you, if you go by this formula that I've given you, it will still give you the number. Okay, so trading is all about the numbers. It's not about how accurate your strategy is. Okay, and this is where I've seen mediocre strategies winning and passing pro firms more than even good strategies. So don't judge a strategy. Look also at your risk management, because that could also potentially affect your win rate. All right, it could affect your wins. It could affect your numbers. All right, and also assess your discipline, because sometimes we become too emotional, more especially if we take a losing streak. We become too emotional. Sometimes we are overcome with this, fear of missing out. We don't want to miss out a trade. So we throw away our strategy, we throw away our rules, and we start gambling in the market. So trading is only for the disciplined. So meaning that you have to be so disciplined as to follow your own rules. The market doesn't have rules of its own. So it's you that make the rules and come with these rules in the market. Only by you following your rules, planning your trade and trading your plan, are you going to become successful and profitable in this industry. So I believe with these few things that I've shown you, the easy, simple strategy that I've just put into your hands, backtest it, go through it over and over and over until you understand it. Then try to trade it on a demo account. Then get into the real account and see how it works for you. All right. So thank you so much for the time that you took to go through this course. Hello there. Wow. Thank you so much for having gone through this course. I believe the few and simple principles that I presented to you on how you can trade the Nasdaq 100 has really, really helped out a lot. My goal in this course was to make everything simple. Like, I never wanted to complicate things, because I know based off my experience that trading is very complicated on its own, because it requires a lot of your mindset, your psychology. So making things a lot complicated and giving you a lot of things to look out for with regards to trading, your entries, etc., would just make things a bit complex. So I decided to give it to you in a simple way. I don't want you to look at it to say, okay, is this it? Yeah. Simple things often are underrated. Like, you would look at it and say, I thought it's going to be complicated. No, don't think. Just work with what you have, and I promise you it is going to yield a lot of results for you. You can backtest this one, go through it, look at the charts, mark those areas, mark those zones, follow your market structure, mark those support and resistance. All right. Those are the accurate support and resistance that you can mark. And that idea of drawing lines on your chart all over, then waiting for whichever line is going to hold. But you can work with this principle and you see how effective your trading is just going to be. It's going to be so much effective that you'll be surprised. Why didn't I know these things early? All right, so this is where we end our journey in this course, and I wish you the very best. Go through the course more than once. Okay, also understand the aspect of risk management, and also know that trading is not a holy grail. What I just presented to you and what I gave you is not a holy grail, but it's a roadmap that is going to help you become consistent. All right, and you can replicate this methodology. You can look at maybe currencies and other assets and see if it works. But on Nasdaq, it works because I've been trading it on Nasdaq and I've been trying it on Nasdaq. So I find it to be good on this particular market. All right, but you can also apply it on other markets and see how it works. Otherwise, thank you so much, and I wish you the very best of success. I'll see you on the other side. Bye-bye.